told Mike McKee, I think.
So when this market trades on projections from the Federal Reserve, what are you going to say on Wednesday?
I'm going to say it's Euclidean garbage. How about
that?
It's
garbage.
Well, it's France. France is going to win, so it's garbage. You know.
And then what? You're not going to listen to whatever the Fed thinks is going to happen next year?
No, I will listen to Chairman Powell. I think it will be a very, very good press conference. I believe Vice Chairman Clarida will be with us, which is
I've heard that,
really honored.
And Mr. Dudley coming out the other side of the news.
Oh, I didn't know that. Okay, that's a show.
I think that's been confirmed.
Like
I mean, I don't know if Bill knows that yet, but I'm sure it's been confirmed. Let's get to the price action briefly. As we keep telling you, massive week. I think defining week coming up for the next couple of months at least, with inflation on deck tomorrow, then a Federal Reserve decision. For those of you that do follow the dot plot, it is about the 2023 dot and how far that's going to come up. Chairman Powell has been leading us to believe that will bump higher at the next meeting. Equity futures right now up 1/4%. The whole curve shifting lower, 2s out to 30s, just a little bit of flattening for you. We're down about 5 basis points on a 10-year, 352.51. Euro dollar not doing much at 105.66. Crude doing a lot over the last 7 days, down for a 7th consecutive session on WTI crude. Tom, we're just about holding on to 70. We've just had the biggest weekly loss on WTI since April, and we're doing this as China continues to make an effort to reopen, and we're going to talk about this later. The top medical advisor in China's top medical advisor comparing Omicron to the flu. Now, that is a massive change from, what, a month ago?
Oh, 2 weeks ago.
A few weeks ago?
And I would time it to the party Congress, and that they've got the political knitting out of the way, so now finally they can take anti-science and try to nudge it towards the 19th century.
You've called it anti-science.
Oh, I do. I think that, we're not jokes, but we're showing the acclaim of Horizon Therapeutics and what they're doing with Amgen. These guys are the anti-science, that everything at Horizon Therapeutics is science in immunology.
Joining us around the studio table, I'm pleased to say, is Michael Schauer, CEO of Market Field Asset Management. Michael, this is great. We're not going to talk about England.
Let's do that.
I don't know.
Economics, finance, investment.
He's trouble this morning. Let's talk about markets. The consensus view next year is recession. The consensus view next year is that we get this dip in the first half off fear of bad earnings and bad earnings materializing, and then it's something you want to buy into year end, and we end up something close to where we are right now. What do you make of that cute little story for 2023?
I mean, it sounds a little bit easy. I do think bear markets end, so at some point this market will bottom and will go up again. But I think the thing you got to remember is we are still in a bear market that I don't think completed its business back in October. And you got to concentrate on, I think surviving the difficult start to next year. We can worry after that as to whether or not, late 2023 looks like a great place to be, and we're back at 4,000, or whether you're still, dealing with this mess. But, I think this is a bear market rally which has run its course. I think the corporate projections when the earnings come in January are going to be really quite conservative. I think the odds of some form of panic are reasonably high.
When you look at the character of a low, what does it tell you that makes you think it's not the low when you look back to October?
Really, I don't think the narrative had really changed. I still think that the people still think of the S&P 500 as the place to be. They still kind of want to own the same things they owned, a year ago. People are, haven't really given up on technology leadership. They talk as if they have, but, I don't think allocations have really changed yet. The lows I have seen or read about, they're a little bit more desperate than what we saw in October. October was what I would call short-term panic, but everybody was still grasping for the opportunity to get back in.
You have been a student of the income statement. I want to go to my great mentor, Meghdon Desai of the London School of Economics, and Lord Desai would say it's all about profit. You parse XPX versus the challenges of NDX forward. Is the NDX going to be challenged just because the profitless, the game's over?
I think the danger in the NDX is that the profitable part isn't as profitable. And you had these incredible corporate margins in mega cap tech. They've just been, literally licenses to print money and have been given the kind of valuations that you only see in great bull markets. I think that their profits are going to be less certain in 2023, and That's where the worry is. Profitless tech, it's down 80%. It's got fairly small market cap now, and it's not somewhere that I want to be. But that's not what pulls the NDX down. It'll be the big guys that pulls the NDX down.
Do they get revenues come in, or is it down the income statement where it is about margins?
I think it'll be hard to maintain margins in certain cases. You look at somebody like Amazon is going to be a sort of margin story, but I think top line revenue growth projections are going to be a little bit wobbly next year.
Something you've talked about that I haven't heard many other people talk about is the potential for a lost decade in parts of this equity market.
Yep.
And when you talk about the lack of capitulation you've seen when it comes to people who just want to buy growth every time we get a growth dip, can you walk us through why you think there is real potential here for a lost decade in some of these growth equities that dominated the bull market of the last 10 years?
I mean, a lot of the story is simply the overcompensation that you had post, I'm going to say 2017, when a lot of this kind of move was multiple expansion. On the Bloomberg terminal, there's a function GE which literally shows you PEs, and what we used to joke around with is GE back in the late 1990s, and what you could see was that all of GE's price progression was multiple expansion. Their earnings were actually fairly steady. Now, tech wasn't as egregious as that. You had genuine growth of earnings in the large cap technology companies, but you had a big expansion of multiples. You did, I think, in many cases, they've overgrown. They've grown to the point that it's just, extremely difficult to project forward another 5 years and see the sort of growth that you had 2018, 2022. And it's just kind of how markets work, is that indexes have, wonderful periods of time. And it's been really a wonderful period of time in the S&P since 2008. And then the index constitution sort of just becomes where you don't want to be. And it doesn't take 5 years to fix that. It takes about a decade, sometimes 15 years.
Well, we thought we had the cheat code, didn't we? It was passive investing.
Yes.
You just bought the index.
Yes.
You ignored everything, and you held onto the index. Are you saying that there's a real challenge now to passive investing, just at the index level for the S&P, just about SPX
absolutely.
and sleep well at night?
I don't think SPX is going to be the place to be. There may be another form of passive investing. Right?
Sure.
Maybe it's equal weight. Maybe it's global. People bought EEM in 2002 and sat on it for a decade, and that's all you had to do. So I still think a form of passive investing will survive, but the S&P 500, that's unlikely to be the place to be.
I look, Michael, and Matt, be sure this gets up here. This GE function is outstanding that Michael Scholl uses. For those of you on the terminal, to take AAPL equity GE Go is the way you can pretend you find your inner Michael Scholl, I guess I should say. You have a paragraph on what the buzz is right now, and it is into spring of next year, and that is a collapse of commercial real estate. One of the great services has commercial real estate down 13% nationwide, and you're saying there's some real liquidity commercial real estate issues here. Discuss that.
I think there's a real problem in the way commercial real estate prices. It's nobody's fault, but there's no public market for commercial real estate, and therefore price discovery doesn't really exist. So, what you've seen in commercial real estate, particularly over the last 6 months, is just transactional volume has ground to a halt. The deals which have been done were largely negotiated before interest rate projections changed. And yet, in all of these large funds which exist, nothing actually marks to market. So, I think that the NAVs in an awful lot of investable product are largely mythical. It's not that the buildings have collapsed in value. They're still, in theory, worth what they were worth. But good luck's getting somebody to actually buy it for that. It's not going to happen.
So here's the question I've got when it comes to private markets. Does that introduce a new layer of risk next year for public markets? Do you see the bleed through from one to the other?
Yes, there is a bleed through because people own both. And so what happens when they start to panic about the value of their private portfolio is they start to de-risk in their public portfolio. And so there is an obvious link. I think the link is perhaps more obvious in credit markets than in the direct link in equity markets. But I think if there is a sort of credit story to this Fed tightening, it's likely to spill over from private credit. It's likely to spill over from either commercial real estate or venture capital lending. But those really were the two areas of excess where the banks pulled back and the non-bank lenders, really went to party.
It's just hard to believe, Tom, that the price to pay to blow up 10 years of central banking easing is 15-20% on the S&P. I've mentioned that a few times. I find that difficult to get my head around. When we write a chapter of this in the economic history books and we say, yes, we had 10 years of of easy money, zero rates, and
Right.
massive balance sheets, and we tried to unwind it, and the price we paid was 20% on the S&P. I struggle with that. I really do. I struggle with that.
Well, it's a regime shift, and to me, as you mentioned it, John, and I think I think everybody watching and listening knows this, that we believe it is about money. I call it a dire straits economy. That's what we had for 3 years, money for nothing. It's over.
Mark Knopfler was awesome,
You
wasn't he?
see it every micro thing.
Where does Knopfler rank for you in guitarists all time?
Oh, Knopfler's huge.
Like,
I
right
had
up
the
there,
honor
top
of a
five?
night with him at the Bluebird Cafe in Nashville. Total class act.
Top 5 all time?
No, top 10. I don't know.
Okay.
He had a style. He is a stylistic guy, and he's a hell of a nice guy.
Michael Schau of Marketfield. This was awesome. He's a hell of a nice guy. Futures on the S&P, up a third of 1%.
Argentina?
This
Really?
is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. A man charged in the 1988 Lockerbie bombing of a Boeing 747 that killed 270 people is in U.S. custody. He's been identified as a former Libyan intelligence officer. The U.S. calls the suspect a third conspirator in the attack, saying he helped build the bomb that destroyed Pan Am Flight 103 over Scotland. Germany's Chancellor Olaf Scholz will hold a virtual meeting of the group of 7 leaders today to discuss Ukraine's immediate needs. That's following Russian missile attacks on the country's energy infrastructure. Meanwhile, President Biden spoke to Ukraine's President Volodymyr Zelensky. White House says the president affirmed the U.S. commitment to keep providing military and economic aid. In the UK, the government is planning for military staff and civil servants to cover for striking rail, health, postal, and other workers. Strikes are planned for almost every day through the rest of the month. Workers are demanding pay hikes that keep up with inflation. It's the biggest wave of industrial strife in the UK since the 1980s. It's Amgen's biggest acquisition ever. The biotech giant has agreed to buy Horizon Therapeutics for $27.8 billion. Now, that represents a 48% premium since the developer of autoimmune disease treatments disclosed it was in talks with 3 potential buyers. Both Sanofi and a Johnson & Johnson unit dropped out of the running. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
multi-trillion-dollar industry, there's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. Welcome to the world of decentralized finance.
I'm going to take a look right here at regulation.
We are seeing digital currencies under some pressure.
Bloomberg's covering all things crypto. The people.
I want to have some of my money outside of the sovereign.
The transactions.
It all comes down to the details here.
And the technology.
How does that affect disruptors like you?
What happens to everything that you're investing in when the last Bitcoin is mined?
Bloomberg Crypto, Tuesdays. It's a big week for the U.S. economy, and Bloomberg's got you
My
covered.
head's spinning here.
First, tomorrow morning, CPI data comes
We're
in.
seeing things work themselves out.
This is going to be a really choppy ride.
Then on Wednesday afternoon, a special surveillance will cover the Fed's last rate decision of the year.
Power of that Fed speak is declining.
Does this Federal Reserve have the commitment to keep going?
The question is, how high do they have to go?
The CPI report tomorrow morning and the Fed decision Wednesday afternoon. Right here on Bloomberg, your global business authority.
I think I said they're people, and I wanted people that worked for me to take seriously the harm and misery that was being experienced by all too many Americans.
It is not just a data point, it's the people behind them. That was Secretary Yellen on 60 Minutes over the weekend, dropping the F-bomb there, TK, over the weekend. What do you make of Janet Yellen Unleashed?
No,
Colbert, she was
she's
great.
been unleashed academically
60 Minutes
for
over the weekend,
years.
great. But Tom, this is coming all after we thought at this point of the year that maybe Janet Yellen was leaving the administration. And that seemingly is not what's happening.
I mean, she's young compared to the
down in
president,
Washington.
that's for sure. What I would say, John, is let's review why she's acclaimed in the modern era, and it's this word slack. And as a massive, massive conundrum for the American economy is a level of slack of Americans not participating in our modern technology economy.
You see the rumor about Moynihan? You see that rumor?
No.
The reporting, I think it was from Fox,
In
actually.
France?
No, that Moynihan was in the mix to be the next Treasury Secretary.
Well, yeah,
that report doing the rounds in the last couple of days, which is odd.
Yes, I would, but
we used to talk about
Lawrence
Jamie Dimon
Fink,
being in
yeah,
the run.
Lawrence
yeah,
Fink
we've done this a few times. That rumor,
John
that
Farrell.
target seems to make. I don't think anyone wants that. That target seems to shift around Wall Street now and again, doesn't it?
But then the politics runs into, do we want somebody from Manhattan to be, running the ship? And that runs into, let's do this. It's too important right now. Emery Horton's surviving a weekend, and she understands that in the heat of the America's Cup, as you look at Washington and all, you need to take phrases from the America's Cup. And so what we're going to say is right now, we press on and we pull back with Anne-Marie right now. Is Washington riveted by the World Cup, Anne-Marie?
Some are. I think, it's across America, whether or not you grew up either following soccer or football for John, and whether you enjoy it. I mean, I personally obviously love the World Cup. It's unfortunate for me that it's every 4 years, but at least we have UEFA and other competitions to look forward to. But I think people were more into it when America was winning. But now, I mean, who do they decide? Who do they choose?
France. Anne-Marie, let's go to John Denver right now, almost Cinema, West Virginia. I mean, Joe Manchin doesn't watch soccer. We know that. But is he the next to fall in the Cinema independent sweepstakes? I mean, to me, that would be a shock to see Joe Manchin do a Cinema because he needs to get reelected.
There was tons of questions about this over the course of the past year. Of course, when he was negotiating with the White House on Build Back Better, which later basically became the smaller version of that for the Inflation Reduction Act. And so far from him and his team, it's that he has no plans to register as a Republican or an independent. Greg Valliere, actually, Tom, talked about this today, and the quote was, I have it up right here, could Joe Manchin consider a switch? That potentially would scramble the Senate math, but we're hearing that Manchin has no interest in leaving the Democrats, even though, as you say, Tom, he does face a really important and critical and potentially difficult re-election on the next Senate for him.
Into the difficult 17 days in the calendar year, give us an update on Mr. McCarthy of California. I mean, he's the other point of tension, I would say, into the holiday season.
Well, of course, we were waiting for the Republicans to then anoint him, the House Speaker. The biggest story right now on the Hill, of course, is spending of the next government. And right now, they have till the end of Friday this week to do so. The Democrats were supposed to come out with their spending bill today. The Republicans had said, if you do that, we will not be signing up for that. But what we are hearing is that over the weekend, they have made some progress. They're about $27 billion apart. It sounds like a lot, but when you're talking about $1.8 trillion of funding, it's really not. What will likely happen is that they'll at least kick the can down the road, and they're going to extend it, not so unlucky for all the journalists and politicians on the Hill, till December 23rd. And we'll see whether or not they are able to get a full year of funding, or then it just gets kicked into the new year.
Anne-Marie, what a moment with the Treasury Secretary on 60 Minutes with Norah O'Donnell, looking back to her time at the San Francisco Fed back in 2009, and reminded of the words she used to remind her staff that real people are going through real issues. AMH, I'm hesitant to use this word rehabilitation, but I'm going to use it because there was a belief that by the end of this year, Treasury Secretary Janet Yellen would no longer be Treasury Secretary, that she'd be on her way out. And it just feels like going through the media over the last couple of weeks, it feels like the rehabilitation of Janet Yellen. Can you walk us through what's going on here?
Yeah, she sat down for a lot of interviews, and it's not just, the name brand networks like 60 Minutes for an in-depth. She also sat down with Stephen Colbert, right? She's coming more into, I would say, American households. She also just had this really important moment for her where she signed the first female Treasury Secretary to sign our dollar bills. So there's been this exciting times for her, and she says that she has no plans on leaving, and she's getting out there talking to the press a lot. So it does seem that that is true, even though there was lots of rumors sparking that she could potentially be saying goodbye to that post following the midterm elections. Of course, the midterms where the Democrats didn't do as bad and actually did much better in the Senate than many were expecting. If you go back, though, to that report on Friday from Fox Business, the newest name that was potentially going to take on that post was Brian Moynihan. He also has refuted that, saying that he has the best job in the world.
Well, Gina Raimondo was another name for, I think, the best part of the last 12 months, Anne-Marie, that was thrown around too, wasn't it?
Yeah, Gina Raimondo was definitely thrown around, Commerce Secretary. She's been this key critical voice on really integrating the private sector with the government, with the White House, explaining a lot of what the U.S. administration, the Biden administration is doing when it comes to things like, say, chips and how you trade with China. Also, she's been really at the forefront in bringing manufacturing back to the United States, really touting that CHIPS Act and the money this could mean and the subsidies this could mean for companies if they make these chips in the United States. So she was also touted, and there are many that would like to see her potentially take that next step, but no one seems to be pushing Janet Yellen out for it.
I'm glad you guys bring this up because, John, I really haven't thought about it. Do we have a house cleaning, a constructive house cleaning by the administration?
That's what I'm thinking about. You know, in the UK,
January.
that phrase we use, that cabinet reshuffle. We'd always get that periodic cabinet reshuffle. Anne-Marie, we asked Brian Deese about it. I think he was a little bit evasive. Is it fair to say he was a little bit evasive in our conversation last week? Anne-Marie, where is that reshuffle of this administration? Are we looking for one?
We definitely are looking for one. I mean, there's rumors about Brian Deese. You guys asked him pretty directly, and he did not want to answer. These are awkward moments for these individuals when they're deciding what to do next. And then, of course, there was that Axios report that, potentially Ron Klain would also be one that's looking to go, especially given where the president is. It would be a time for him to leave the president in good shape. Foreign policy, they were able to continue this united front with the West against Russia. You have falling gas prices. This is something Ron Klain has been obviously obsessed with. And of course, the midterm election. There was no red wave. So potentially this is his moment to leave. You say you should leave your job at the peak status of you at your job. This could be that moment for him. But with Biden, he really likes to keep his staff with him. So it's very difficult for people to leave the quote-unquote Biden family.
These jobs are exhausting as well, which is why you expect people like Ron Klain to make a move. Anne-Marie, can you tell Tom never to miss a World Cup viewing party at my house ever again?
Never again. Yeah. It was so much fun. And you really get an insight of what kind of soccer dad John is going to be.
Yes,
that one's
it'll be
going to be pretty intense.
We're planning on that. That's actually scheduled in.
Press.
4 years.
There was some
press on, lads.
There was some real cursing going on in that room.
You mentioned AMH. Thank you. You mentioned reshuffle.
Never mind that F-bomb from Janet Yellen.
Yeah.
I mean, the amount of F-bombs at my place on Saturday.
Is there going to be a Gareth reshuffle? I mean, I read his biography, and he missed a penalty shot. He missed a penalty shot
in '96,
25 years ago, or whatever. But isn't he a success?
I mean, based on recent World Cup history, what are we talking about here? A semi-final, last time around, a quarter-final, and getting really, really close to getting past France. And you'd have to think that would open up the path to get to the final this time around. A final at the European Championships, they lost to Italy on a penalty shootout.
For North Macedonia.
TK, I mean, I think there's a lot of people that would like to see Gareth Southgate stay with a team, but whether he does remains to be seen.
We'll have team coverage from London on that.
Is that what you're trying to make happen?
Yes,
is that what you're trying to make happen? A snowy UK, I'm told today. So
it is.
Stay warm, stay safe.
Flame cancellation.
Futures up 0.25% on the S&P, and this is Bloomberg.
Lots happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot. We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
Mike Wilson of Morgan Stanley this morning, just absolutely brilliant. We're all focused on CPI and the Federal Reserve this week. He calls it yesterday's news.
Yep.
Says the final chapter to this bear market is all about the path of earnings estimates, which are far too high, in the opinion of the team over at Morgan Stanley. Let's get you some price action. Your equity market looks like this on the S&P 500, up 0.2%, up 0.25% also on the NASDAQ, slightly firmer going into a massive week ahead. In the bond market, 2s, 10s and 30s, trying to erase some of the move from last week, I guess. The 2-year last week up 7 basis points, the 10-year up around 10 basis points. This morning in the bond market, 2s, 10s and 30s shaping up as follows. Yields down by about 4 basis points on a 10-year, 350, 360 on a 30-year. Down, let's call it 5 basis points, 351. Down just 1 on a 2-year, 433. So you've got some curve flattening in the mix. And just to round things out on crude, just want to sit on oil. Longest losing streak on WTI potentially since August 2021. We are down for a 7th session, Tom. We're nudging lower by 0.4 of 1%.
It's the way we're down. It's just a
persistent.
Just as grind down lower and lower. And yeah, and I'll let adults tell me where we're going to end up here. But to see a 69 handle on West Texas Intermediate is important. John, I think we got to reframe tomorrow's festivities. And what you need to know, folks, is we all talk, and I do this as well, year over year. The adults are talking month over month, and it's easy for you. The Bloomberg survey is both month over month, CPI 0.3%, T2 30-day move, and then also core inflation, the same statistic, 0.3.
Can we get a 0.2 on core? Just to get that kind of deceleration.
Those little tweaks there, and then it goes into the year over year. But just to frame that out, to me, we're going to do Fed decision.
Fed decision.
The inflation decision.
Inflation tomorrow morning, yes. 8:30 Eastern time. The Federal Reserve decision, then on to Wednesday at 2 p.m. We've mentioned this a few times. The Fed, just one of 9 central bank announcements coming this week. Ahead of that decision, investors weighing in on what to expect from the central bank.
The Fed doesn't want to actually grasp the nettle and tighten financial conditions to the extent that would be necessary to really kind of guarantee that recession coming through.
This is the conversation right now, TK. Will he lean against the easing of financial conditions that we've seen in the last couple of months? Citi, Andrew Hollenhorst publishing just moments ago, they say the following: we see a hawkish risk to Wednesday's meeting despite the slowdown to a 50 basis point rate hike pace. Looser financial conditions are unlikely to sit well with a committee that is likely now more concerned with persistent inflation driven by a rise in labor costs. Hollenhorst and the team at Citi, Tom, just moments ago.
We're jargon free here. Freya. And Farrell, for you, you're like, it's in English, but for us, we're like, what? Grasp the nettle.
Grasp the nettle.
To property of a plant to inject toxins into the skin of any person. So is Powell going to grasp the nettle and inject a toxin?
You don't have nettles? You must have nettles here. Did you not call them nettles? Those like spiky bushes?
I don't know. Yeah, I go to Central Park once a year. What do I know?
Like grasp the nettle? You don't have that phrase here?
No, well, sort of, but no, it's foreign.
Okay.
It's foreign.
Well, I'm here to translate whenever you need.
Well, you're doing that every day because we're grasping the nettle as well. What I look at, John, seriously, into grasp the nettle, and you mentioned it, is a dot plot. So are they actually going to move the dialogue, the dot plots? I'm not so sure.
So they moved the dot plot at the September meeting in the latest projections. Every time we've heard from Chairman Powell, he has indicated that the 23 dot will go higher. Now, Tom, how much higher, I think, is the conversation we've ultimately got to have? Does it have a 5 handle for 23?
Yeah. Okay.
And is that a hawkish surprise if everyone's expecting it anyway, going into Wednesday's meeting?
You're killing me. I don't know. There's many dots. There's like, what, 8, 9, 10 dots, and I guess 1 dot that matters. And what I know is Deborah Cunningham, with a long-term maturity of 27 days, really doesn't care about the dots. She joins us right now from Federated Hermes. I got to ask you about this because it's major in the news in New York City. Deborah Cunningham your world of visible, publicly traded short-term money is somehow linked to any potential blow up in commercial real estate. What should our viewers and listeners look for in the short-term paper world that begins to show tensions within commercial real estate next year?
Well, first of all, let me say good morning to everyone and tell Jonathan I do know what stinging nettles are. I grew up in very rural central Pennsylvania, and I understand the term, and I've had it on, I've done it before. I grabbed the nettle and it's painful. It doesn't last very long though. So going back to the commercial paper market and how that might be linked to commercial real estate. Really, from a standpoint of asset-backed commercial paper, that's probably the clearest linkage.
Yeah.
And what you might see backing asset-backed commercial paper are a number of different types of assets. They're usually very short-term, quick turnover types of assets. They're credit card receivables, they're trade receivables, but there are some commercial real estate receivables, very small amount, in asset-backed commercial paper, depending on what program you're looking at. And if you start to see liquidity dry up a little bit on that paper, if you start to see some sort of spreads widening, which we have not seen even, a small amount of, that's probably the sector, and that and the banking sector. The banking sector, obviously, with their real estate commercial real estate portfolios, also has exposure there. We have not seen that yet.
This is wonderful. Very importantly, Deborah, can you count it? Is it a shadow banking system or a shadow asset-backed system, or is it very countable and observable to the industry?
It's very countable and observable. I mean, obviously, bank portfolios are fairly transparent at this point. We get a good look into the portfolios and the loans on banks' balance sheets. And I might note that when you look at the banking sector today compared to the 2008 banking sector, the balance sheets look a whole lot healthier, a lot more reserves, a lot more a lot fewer non-performers and better asset quality. On the asset-backed side, there are what are called monthly transmission reports that basically have the same data comparing the loan portfolio that back that paper, similar to what a bank would be. So it is transparent, but you have to go out and look for it.
So going on to distant maturities like 2 years or beyond, how do you deal day to day and adapt to the massive curve inversion on 15 spreads that are the convention of your world? Is this curve inversion like 78, 79, 81, 82, or is it different this time?
You know, I think coming from a zero base makes it a little bit different. We've operated for, most of the last 14 years in a zero rate environment. And I think to a large degree, what has built up from an inflationary perspective, what has built up from a business cycle perspective is a little bit different than anything that we've had in the past. So I do think there will be, we're expecting either slow growth or a mild recession. But in either case, I think the important part that is distinctively different in this business cycle and why it may look different from, a curve inversion and a bond market yield perspective is coming from the base of zero makes it different.
Deborah, going into Wednesday, where do you think there is scope for surprise?
I think perhaps you're going to continue to see the Fed voters and the dots themselves. You were talking about it before I came on, the segment before I came on. I think you're going to continue to see that go higher. So, I think the higher, sooner, and for longer just is missing the sooner right now. I still think the Fed is very much on a glide path that is higher for longer. So I think you're going to see that terminal rate and that central rate go, increase. And I think the time frame for which it remains at that higher level will be a longer time frame.
Well, longer will come down to the data, and we can talk about that time frame now. As for the peak, I think Goldman's got it at 5 to 525. I think others are in the same kind of ballpark. When it comes to longer, Deborah, I want to ask you to guess where the data comes in. I want you to help us understand how you think this Fed will respond to that incoming information. How high is the hurdle for the Federal Reserve to cut interest rates at the back end of next year? How bad would the data need to be?
Well, I think you really have to see inflation. Inflation is the key. So, we've seen it go from 10.98, depending upon what, measure you're looking at, down to, let's call it 8.76. And so you've got 2 percentage points from an annualized perspective taken out of the system with, 300 plus basis points in increased rates in that time frame. Now we're on a path toward that end. So it should take less increasing rates to get another 200 basis points and then another beyond that. But getting down to 2%, I think, is pretty difficult. I don't think you get there quickly. And I think the Fed will have to look at the data and sacrifice to some degree the inflationary side of it going. Maybe they get to 3 or 4%, but I don't think they want to, sink the country into a more severe recession. And as such, I think that they, will likely have a time frame when they have to, sort of weigh the differences between, am I going to have inflation another 1% lower, but a recession that's maybe 2 or 3 or 4% worse? Or do we think this is an okay place to stop for now? And I think that takes us well into 2024.
Deborah Cunningham of Federated Hermes, fantastic as always. Tom, this is the conversation right now, high for longer. It's the longer piece of the high for longer phrase, where there is great debate when you have a market pricing in cuts and a Federal Reserve is basically saying we're having nothing to do with it. I mentioned this in a previous hour. I mentioned it again for people just tuning in. Craig Torres and Liz Capper-McCormick out on Bloomberg over the weekend with this article. Over the last 5 interest rate cycles, the average hold at a peak rate was 11 months. 11 months. And when you go back to the 95 cycle, Tom, they held for 5 months. Peak rate of 6%, and they went back to 525. And you wonder if we do get a reset, Tom. Is it a reset of recent memory where you go all the way back down again, or is it just kind of an adjustment away from 5 back down to something like 4?
To the strength of their article, or one of our bond access with the great Craig Torres of economics, is nobody has a clue.
No, of course not.
I think what I would say, John, is look at consensus and be very wary of it. And consensus has been that we come down with some rapidity. And I just am like, okay, maybe.
We don't have a crystal ball. Okay.
No one does.
We don't. And my question really is not about where you think the economic data is going to be. It's how you think the Fed will react to it. It's a reaction function question.
I think the Fed is going to react on a reality that they don't look at 3.7% is any type of success.
That's not mission accomplished.
Hugely. And to me, that's the heart of the matter and the heart of our discussion on Wednesday as well.
We've got Dara Mayer coming up.
Good. On FX, need that.
Looking forward to that. It's going to be in the studio, I'm told.
Oh.
From HSBC here in New York. This is Bloomberg.
I think he had Croatia.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. In China, COVID is rapidly spreading through households and offices after the country's pandemic rules were eased. And that's led to turmoil in poorly prepared hospitals. Some facilities are struggling to find enough staff, and others are suspending non-COVID treatments. There's a sign that China and the U.S. are taking steps to ease tensions. Beijing described its meeting with U.S. diplomats that included talks on Taiwan as in-depth and constructive. The two sides met outside the Chinese capital. That was a follow-up meeting to the last month in Indonesia between President Biden and President Xi Jinping. That's led to a resumption of cooperation on several issues. Scientists in California have made a breakthrough in nuclear fusion technology. Bloomberg's learned that for the first time, they produced more energy than consumed in a reaction. It took place at the Energy Department's Lawrence Livermore National Laboratory near San Francisco. While the results are considered an achievement, it's still a long way to creating a viable technology. Private equity firm Thoma Bravo has agreed to buy Coupa Software for an equity value of $6.2 billion. That represents a 77% premium to the California-based company's closing price on November 22nd, prior to a Bloomberg News report on its potential sale. Thoma Bravo outbid Vista Equity Partners for Coupa. Microsoft has agreed to buy a stake in the London Stock Exchange Group. The move will give the software company a 4% equity holding, which is currently valued at about $2 billion. The stake is part of a long-term agreement to help LSEG develop data analytics and cloud infrastructure using Microsoft's products. The group will spend a minimum of $2.8 billion on cloud services over the next 10 years. Global news 24 hours a day, on air and on Bloomberg Quick Take. I'm Lisa Mateo. This is Bloomberg.
You do not get stronger that moment that you're lifting the barbell. You get stronger as your body is making repairs, making recovery. Recovery is when and how you get fitter, faster, stronger.
Recovery technology includes everything from massage guns and foam rollers to compression boots, hyperbaric chambers, cryo chambers, infrared saunas, and even infrared pajamas. And athletes are partnering to become investors to take those products mainstream.
When you look at tech in sports right now, it's completely innovating the way training's going, completely changing the way recovery's going. I think sky's the limit as far as where it can go.
But while some of these products can feel amazing, it can be difficult to differentiate between what really helps the body and what just tricks the mind.
Every time you're chasing the latest, greatest, newest tool, you're probably chasing a mirage.
No one covers the world like Bloomberg.
My team thinks 2023, we avoid a recession. I'm a little more skeptical about that.
China and the U.S. both do not want to see nuclear force on the European continent.
The regulators here in the Bahamas are ongoing with their investigation into FTX.
With unmatched reach and resources from more than 120 countries, the moment news breaks 24 hours a day. Bloomberg, your global business authority.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
We're in the disinflation camp. I think the problem is that because of the lags that are involved, it will take time to feed its way through. And the market, when I look at the shorter end of the market, it's already discounted or re-rated what the Fed's going to do.
That was the brilliant Kathy Jones of Charles Schwab going into the Fed decision coming up on Wednesday. Before we get there, CPI coming up on Tuesday. I've said this a few times this morning. Mike Wilson of Morgan Stanley says yesterday's news, it's all about the earnings in the first half of 2023. And I think a lot of people on the equity side might agree. Your equity story looks like this. In the equity market on the S&P and on the NASDAQ as well, we're just a little bit firmer, Tom. Up a 0.25% on the S&P, up by about 11 points.
It's going to be interesting. Yeah, there's a little bit of a lift here, and I'm watching the VIX carefully. It hasn't given me any love yet. It's still a point of tension, 24.26. It is time for Global Wall Street to lean forward. For one of the great calls of the last number of years has been the persistency and courage of HSBC to say strong and resilient dollar. They amend that, sorta. So we have a sorta kind of like discussion with Dara Mayer, head of Research Americas, and the head of US FX strategy with the great Paul Mackel as well. There's an ambivalence to your note. You're not calling for weak dollar, right?
Well, we're calling for a dollar correction. It kind of amounts to the same, but it's not this big trend reversal. In other words, we don't undo everything that we've delivered by virtue of dollar strength over the last 18 months or so.
Let's talk to people like John who, trade off of, folks on the break here, John's doing FX trades here.
Can you not start rumors?
Can you not? I wouldn't want to do that, but is it a tradable come off the bloom after, that's a pun there, come off the bloom, get that, David Bloom?
Great guy.
Nailed that,
Great
okay. Is it a tradable come off the bloom, or is this going to be a messy sludge where nobody really makes big figures?
Look, our thought process was, we described it, we thought this would be the chop before the flop. We'd have this really choppy period, and then we'd get the flop in 23. Yeah, but nice phraseology, but completely the wrong way around, because what we've had is the flop, and we're still kind of waiting for the chop. Okay. The reversal we've had over the last, we changed our dollar view for dollar bullishness to dollar choppiness and then weakness just a month ago. And in that month, we've had like one of the biggest monthly declines in the dollar. So it's really, even for quote unquote a bear like us now, or a newfound bear like us, it's been a big old move. I wonder, is the choppiness about to come though, into the CPI, into FOMC? and into kind of the beginnings of January, where everybody thinks they know what the trend is for 2023, and then they're all suddenly forced to revisit in the first couple of weeks.
Is there a risk that we're overplaying the one side of the currency pair? When I think about euro dollar, which got down to about 95, and then we avoided the worst case scenario coming into winter, we had that period of mild weather for the Europeans. When I think about sterling getting down to 103.50, I think intraday the end of September, and coming back through 120, largely it was the other side of the trade. It was the sterling side, the euro side that really kicked off that move. We cleaned up the policy story in the UK. We avoided that terrible winter and the shutdowns we anticipated. Maybe they still evolve, I don't know. But do you think we're overplaying the US side of the currency pair?
I would say, look, 2022 showed us that the dominant thing to get right was the dollar. I mean, we could at the margin, we had periods where this sterling was the swing factor, a couple of periods where euro was, but I mean, look at us this week. We have got an ECB meeting. We have got a bank meeting.
We're not talking about it.
Who knew, you know? But I think there's a recognition, and the reality is you've got to get the dollar right. And in a way, before you get the dollar right, you've got to get the S&P right, because risk appetite has been the core of everything that's happening in the FX market and to the safe haven dollar.
So I'm not trading rates next year, I'm trading sentiment.
You're trading row, risk on, risk off.
Right,
all
we're
the
back
way.
to that.
All the way.
Back to that. So when you think about paying some of that choppy dollar weakness through G10, what's the select currency pair you want to do that through?
I think the high beta currencies on the way up in the dollar should be the high beta currencies on the way down. So your Aussie, New Zealand, your Nocky Stocky, and less so the Canadian dollar. And we've seen that even in this dollar sell-off. You know, Canada has underperformed others. So I think you go to the, I mean, honestly, I'd say the Aussie perhaps and the Kiwi. Norway and Sweden, I know that's what you're day trading just as we came on air, but you know, they're for the braver man. They're for the braver man, and that's why you're still having to do this gig as well. So I think Aussie, US dollar, Aussie, US dollar, and New Zealand, US dollar, they'd be the two.
Does China reopening reinforce that trade?
I think it's being overplayed a little bit.
Why?
I mean, the transition is going to be complicated towards, you know, a reopened China. Perhaps the market's slightly over-egging the tourist angle and what that might mean in terms of flows. But it is encouraging, and the pro-growth stance is encouraging. But, you know, even at HSBC, we've been looking for a rebound in China 6 months down the road for 2 years. You know, as has the market. And it's difficult because every time we think, okay, we're going to get there, we don't quite get there.
Fair, and you got the leadership there with the Hong Kong position, the Hong Kong and Shanghai Banking Corporation. What is the pair in the Pacific Rim to play Asia Open?
I think Korea will be one. It's
KRW
high beta. KRW, yeah.
Against what?
Against the dollar. I mean, I think that's...
You got to go against the dollar,
I think
really?
I think it's the cleanest way.
Okay.
I mean, I think you do... to your question earlier, you do have to come back to a dollar view. Now, then how do you express it in Asia? I think Korea is one option.
Right.
I guess the Rand is another high beta option.
Right.
Brazil is one you could like. So there's a few out there, for sure.
Mohammed from Cairo and Cambridge emails in and he says, would you ask Dara about Durham Kuna? I mean, if we get a Croatia-Morocco final,
yes.
I mean, they've got all these obscure currencies. I mean, going there. Are you like long the dirham?
Do you know what? I'd love to be able to give you.
I don't know where you're
I would
going
love
with
to be able to give you the big figure in that cross, but I have no idea. But as I was mentioning in the break, I am trying to dust off my family tree to see if I've got any Moroccan heritage in there, so I can join in the celebrations when they beat Croatia in the final 3-0.
It's been fantastic to see. You think a Croatia-Morocco final? Is that what you're looking for now? On Sunday?
We've always been counter-consensus at HSBC, so why not?
Soccer guys, can I ask you a question? They play before the Sunday game, like the second
Tuesday
place
and Wednesday.
Game? No, but the losers play.
Yeah. That's never a great game to watch.
What are they? I mean, everybody's like, "Don't hurt me," right?
I don't know why they played that game. I really don't.
Yeah, it's a tricky one.
It's like a whole
I think
game,
it's
like
finding
90 minutes?
finding the bronze medalist, isn't it?
And also,
you really wanted.
How easy was it to get tickets for this World Cup? I'd love some insight into that, because every time I watch the game, they say it's another sellout, and I'm like looking at the stadium.
I'm totally with you.
Are you gaslighting me? Because I could see literally
France-England was like
thousands of empty seats.
France-England, I thought was busy, but
why do they keep saying it's a sellout when there's thousands of empty seats?
Well, look, in England, you might think they're all down the pub,
right.
But you know that could be a risk. I don't know. It just you can sell a ticket. It doesn't mean you have to turn up.
Is Steve Major made an appearance yet?
Have you spoken to Steve Major?
No.
I have spoken to Steve Major. I don't know if he's been at any of the games. I think he's watching from Hong Kong.
He's probably looking forward to Premier League football starts in the new year again, Tom, and we can sort of move on with life and forget about all this. You keep bringing up this England loss, don't you? You just won't let it go.
No, I'm fascinated by it. As a foreigner, I mean, I'm a foreigner to soccer.
Okay, let's get to the foreigner point of view. Do you think we've set the stage for a great World Cup in 4 years' time in North America,
It
in
is
the US, in Canada, and Mexico?
factors superior to where we were 90 days ago. Is it a big deal? I think, yes, it will be a big deal to a new America.
A younger,
and there's an older
younger
America.
audience.
Right now, I'm focused on, is Carlos Rodon going to end up with the Red Sox? That's all. You'd
You're just
love
thinking
him.
about that. Okay.
He's like the Mbappe. He throws only fastballs high in the strike zone. But that's a diminishing America, and it's an older America. And the new America, I think, will really embrace it. Does Fox have, tell me Telemundo is going to do it.
I'm sure they will.
I watch on Telemundo.
But I was there in '94 for the original
Too- it was
USA
too
World
early.
Cup,
It
Soccer
was too
World
early,
Cup.
wasn't
Well,
it?
it's too early for the US, but Ireland beat Italy, so one more, I'm
Okay.
still living off
I'm
that
aware
one.
of that.
Still
Italy
living.
played?
Yeah, Italy played and lost to Ireland
I
in
cried.
New York. Can you
I
imagine
cried in
the
that final.
atmosphere was for
I
that
cried
one?
in that final.
Can't even
Against
remember that final.
Brazil. Penalty shootout.
Oh, yes, it was,
Yeah.
isn't it?
Yeah. Roberto Baggio over the bar. I think Franco Baresi missed the penalty. I think Massaro missed the penalty.
Does he
AC
remember
Milan
this and yet
striker.
remembers nothing about markets?
Oh. Oh. Is Dara one of your friends then?
Yeah, he paid me before
he
he
was
came
one
on.
of mine. You've got me trading Noki Stocky on the side.
Email in, seriously, Maria Tadeo is on leave today, and we thank her for her comments the other day. That was really a high
On leave.
point.
She's got a couple of days
She
off.
gave, I think Maria very courageously gave to a lot of the American audience, frankly global, how people really care about it. I will say with great certitude, we just don't get that.
Their national identity is wrapped up in their football team.
Yeah, it was a
particularly
great
for
moment.
countries like Brazil. For countries like Brazil on the international stage, it's something they're super proud of. So for that to go the wrong way,
We do okay there.
disappointing.
I think the soccer-
I don't know if Dara's coming back. Maybe
I don't know.
You know, if I'm around the table, maybe that won't be happening.
Come back as your sports correspondent.
I'd appreciate that, Dara. Fantastic to catch up with you, buddy,
Cheers,
as always.
likewise.
Dara Mayer
Happy holidays.
of HSBC, to you as
I
well.
thought South Korea looked good.
Futures up a third of 1%. You've got such a Tottenham bias to your
Got that
national
right.
team preferences.
Well, they're in the finals.
You think Spurs are playing on Sunday against Morocco?
Or maybe Saturday.
This is Bloomberg.
So is there more pressure when you're trying to win a basketball championship than when you're trying to please investors? Where's the greater pressure?
Oh, I think it's definitely trying to win a championship. It's hard because a lot of, like when you invest, and you know this, when you're investing, you can control a lot more things. When, you know, on a basketball court, you can't control whether somebody's going to make a shot. You've got to get lucky.
And what's the greater pleasure, making 5 times your money on a distressed debt investment or winning the NBA championship?
They're both fabulous. I wish I could do one each year. That would be great. But I think there's a great feeling in being right on an investment, that you've done a tremendous amount of work and you've made money for your clients, which I think is great. I think winning a championship it's a very surreal feeling because there's a whole city or state that is actually behind you. You know, we had 70,000 people at the finals, and we had them all outside. You had 17,000 in the stands, and then literally like 60,000 people outside. And when we won, like just the joy that you had brought to the city was phenomenal.
Lisa, you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
When I started, I had no idea it was going to turn into this, which is a tracksuit empire. I don't have any investors. All this is all money in. This is me going out and hustling, bringing that money back, and just building it, building it, building it. You got to think about a person that was homeless at one point, didn't really have any money coming in. The fact that this person was relentless and just determined to succeed and not let rock bottom define him as an individual. I can take things and put them together and take them apart and make them better and put them back together. I respect the craft, so I don't want to minimize and disrespect the value of each step of the craft and do by machine what should be done by hand.
Enjoy the excitement of a night of music at Boston Symphony Hall with BSO Now. Watch brand new Boston Symphony Orchestra performances, behind-the-scenes storytelling, and memorable archival concerts, all from the comfort of home. Use our free 24-hour trial and see why the Boston Globe calls it musically rewarding. And the Berkshire Edge says the orchestra has never played better. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
In 2023, there's this sort of kind of limbo era where it's not really clear what's going to happen.
We expect to see a lot of volatility here as we reprice earnings for next year.
The indicators from the inverted yield curve to the leading indicators, I mean, I could go a long list here of things that are rolling over.
Going into next year, we do think that we're going to continue to see housing weak. We're going to see goods weak.
Still a chance of recession, absolutely, right? But probably at best a mild one.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on radio and television. Bramo off today. I haven't talked enough about Bramo. We'll get to that.
3-day weekend.
Three-day weekend.
Into year end, I told you.
Into tomorrow, inflation. Into Wednesday, Fed Day. Yes, we'll be with you Wednesday afternoon. And I'm going to get right there, John. Inflation is a mystery.
CPI coming up tomorrow morning, and how the Fed responds to it, not a mystery. Another 50 basis point hike, widely expected, anticipated on Wednesday. And then, Thomas, your favorite piece of this is the dot plot for 2023. How much higher does that 23 dot go relative to the last projections we got back in September? I'd also suggest you look to the news conference as well. The last few times that Chairman Powell has spoke, I think risk management's been a big part of the approach, the communication. Do they think the bigger risk now, after a 50 basis point hike on Wednesday, if that's what we get, is over-tightening or under-tightening? Do they think the risk of doing too little still outweighs the risk of doing too much? And if that shifts, Tom, to a little bit more of a balanced view, I'd suggest that's probably a little bit more dovish than what we heard in the last news conference.
I agree with the shift idea because there is a history going back a solid 20 years that they always err on an asymmetric basis. And if you get back to symmetry of some way in decision making, that would be a shift in the game, in the parlor game, and trying to figure out the view forward. But I'm going to go back to inflation, and as Michael McKee would say, you go beneath the headline data, and you've got to look at the parse of goods inflation and service inflation. And the thing I see, we'll get to the data check in a moment, is $70 West Texas Intermediate.
I know.
Does that change the Fed debate? Can you imagine if they were having this meeting with a 120 oil?
7 days of losses on WTI crude. That's a big change. And Tom, to your point, there were a lot of people looking for year-end triple-digit crude. We didn't get it. You know what the equity strategists would say this morning, Tom? Forget about it. CPI, the Fed, they've done talking about the Federal Reserve. They now want to talk about the consequences of this tightening cycle. 400 basis points plus in a really short amount of time. They want to have a conversation about the weakness they expect in earnings to dominate this equity market in the first half. That's the overwhelming consensus view on the street into next year.
I'll go there, but on Thursday or Friday, can't remember when exactly, just the put-call ratio, I think Liz Ann Saunders had it out, the put, the negativity versus the call, the more optimism view, the gloom out there witnessed the put-call ratio, which is maybe an antiquated number. The gloom out there is tangible.
Neil Dutcher of Renmac would sit in that chair and Neil would say to us, what recession? Look at the economic data. It's resilient. And in fact, the conversation I think he'd probably like us to have is a conversation when maybe you've got to push that further out. And what does that mean for that consensus view for how equities will perform through 2023?
To me, it's a mystery to it. Let's get the data here and do a complete data check. I thought Darren Meyer was just brilliant there.
It was brutal. What are you talking about?
Ambivalence.
He's on the edge of rude, Tom. Is he allowed back? I heard from Steve Major of HSBC months ago. Steve wrote in, made it to one game, and he said that the atmosphere was fantastic. He said it was a lovely experience. That was the feedback. And for all the abuse this World Cup's taken going into it, Tom, he said it was a lovely experience. Futures right now up a third of 1% on the S&P. Big week of losses last week on the S&P 500, driven by the move low we saw in Friday's session. In the bond market, yields just a little bit lower, Tom. We're down 3 or 4 basis points on a 10-year, 354.33. Talked a lot about crude already. Let's finish on euro dollar TK. 105.54. We're positive there, a tenth of 1%. To Dara's point, I actually think Dara Mayer of HSBC made a wonderful point. Federal Reserve. Who's talking about the ECB coming up on Thursday? We've barely mentioned it, Tom, for weeks.
Well, let's go there. This is something that I've been hugely remiss on. Jen does a better job at this than I do. You've got Lagarde has to come out within a horrific war. We can all agree that's worsened since the last meeting. But to me, the real history is the Bank of England. The chart of the weekend was Javier Blas's electric utility chart, which was truly, folks, a moonshot of expense.
Winter's arrived. Yeah. Snow's on the ground. It's getting cold. Strikes are kicking in over the next couple of weeks as well. So the GDP backdrop, both for Europe and the United Kingdom, the Eurozone and the UK, I think the growth backdrop gets a little bit more difficult, and both central banks are expected to make another move. The ECB, Tom, did you ever think the ECB would be hiking in 75 basis point, 50 basis point increments? Tom, there was a moment in time in the pandemic when I thought we'd go through a whole cycle again with the ECB never hiking interest rates. Yet here we are.
I go back to the war, and I think it's such a wild card that they have to tread carefully. John, asking for a friend.
Sure.
Should Americans fly to Heathrow now?
Well, I'm flying into Heathrow next week.
Yeah, but you've got, like, you can get to Aberdeenshire wherever you're going.
I'm told that passport control, there will be strikes, and they're getting ready to draft people in from the army. Is that right? That's what I read. And we'll see if there is strikes at the border for passport control. We'll see if that actually materializes. But at the moment, a difficult moment for sure.
Ira Jersey to join us later in this hour with a nice bond update from Bloomberg Intelligence. And we're thrilled. Moments ago, we got Will Kennedy to come in on hydrocarbons and oil, 7140 American oil. Right now, Tony Rodriguez joins us, head of fixed income strategy at Nuveen. Tony, I want to go to the heart of Nuveen, the soul, which is municipal bonds, which is a world of their own. What does the demand for municipal bonds signal about the greater bond market?
Well, good morning, Tom. Good to be with you. So, interestingly, the demand that we are seeing recover a bit in the municipal market is really reflective of something that we think is similar across not only the municipal market, but the taxable market as well. And that is a signal that we think investors are becoming significantly more comfortable with both interest rate risk, as we personally expect that we've maybe seen the highs in U.S. long-term rates so far for the cycle. We're expecting lower rates at the end of 23 than where we are today. So greater comfort on that front, and also comfort around the actual credit strength and credit health of state and local governments. So we think they're in very strong condition fundamentally. And we also think that applies to the U.S. consumer balance sheet and the U.S. corporate balance sheet. So the fundamentals are actually in a fairly good spot, despite the fact that we certainly are expecting to go into a weaker economic period in 23, where we're thinking we're likely to see a mild recession.
Well, I mean, this is something. I mean, Bramo's not here to provide requisite gloom, but Deborah Cunningham and Tony Rodriguez are giving us some constructive optimism.
Yeah, but to Tony's point on state and local finances, Tony, I don't hear it talked about enough, I don't think. These guys have got a lot of cash, haven't they? Can you walk us through just how strong that financial position is?
So, Jonathan, as you know, through a lot of the fiscal stimulus, there were direct payments made to state and local governments, as there were to U.S. consumers, and that certainly helped to ease some of the debt burden and any of the liquidity squeeze that we might typically see in a slowdown period. So as a result, the need for, say, the consumer or state and local governments to retrench in the face of slowing economic growth, high energy prices, et cetera, is a bit reduced. It's a result of that we think not that we will avoid necessarily slowdown, mild recession, but that will help underpin a milder, shorter recession as a result of that fundamental credit and balance sheet strength that we see relative to previous periods entering slowdowns.
Tony, that's the shallow of short and shallow. You've helped us understand the shallow piece of it. Can you help us understand the short piece of it? Why do people think that if we do get a downturn, it will be short? It won't be for very long. Why is that?
Yeah, Jonathan, I think the main reasons there are, again, when we think about the Federal Reserve pausing, as we suspect it will be after their final increase in March, but certainly at the latest, one more increase at their May meeting. So it is that pause that we expect to see from the Fed that allows, we think, the economy to kind of reset, digest that higher level of rates, see the slowdown occur in the housing sector, and really build the baseline for a recovery in 24, which, by the way, Jonathan, our forecast would be for about 1.5% growth. So it's certainly not a strong recovery. It's just a return to really below average growth.
Tony, with all the heritage of Nuveen, we've had an historic drop in bond price this year, blended, whatever number you want to take. How many years does it take to claw back? Are you looking at a 3-year horizon to get back?
You know, Tom, I think it's more likely to be closer to a 2-year horizon, because I do think we'll get a bit of a tailwind from lower rates. But you bring up a good point that despite the fact that in the equity markets we've seen, maybe we'll call it a run-of-the-mill bear market at around 20%, we've seen the worst bear market in bonds in over 40 years. So a lot of the damage has really been around kind of higher quality, longer duration assets in this particular market downturn.
Tony, just a final word on the Fed on Wednesday. I want to squeeze this in. Tom and I have been talking about it. He has no interest in the dot plot, never has done. But I think a lot of other people do. Tony, where is there scope for surprise when everyone expects the Fed to maybe push 23 out to a 5 handle?
Well, I think you make a good point, Jonathan. I don't think the scope for surprise is in the dot plot. I think the scope for surprise at this meeting will be in the press conference and how hawkish Chairman Powell decides to be, given that he was interpreted as being fairly dovish coming out of the Brookings interview. I think you'll see a pushback. I think that could be a bit more hawkish than what the market's currently expecting.
Tony, wonderful to hear from you, as always. Tony Rodriguez there of Nuveen. How many times, TK, have we heard short and shallow? Short and shallow?
I don't.
Short and shallow? If the Fed's going to push back against this interest rate cutting stuff, does that downturn get a little bit more prolonged because they won't respond to it?
I had this conversation this weekend. Part of watching financial media is to grasp where consensus is. I mean, if you're in the game, you got to know where consensus is. And I think we try to deliver that every day. And yes, you know, beyond transitory, it became short and shallow in gaming it. There's no research whatsoever that you can game a recession. None. Zero.
The consensus for next year is driving you nuts, isn't it? I mean, it's just a little bit too cute. I'm with you. It's way too cute. We've been talking about it for a number of months now.
You know, I look at the work of Martin Feldstein and what James Durbin at MIT did here with NBER, and the answer is this is complex stuff. And we all speak with certitude. You know, we believe.
First half, equities down. Second half, equities up.
Here's our outlook page, 55 pages.
4K year end, which is where we are basically right now. On the equity market, futures positive, a third of 1%. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. A man charged in the 1988 Lockerbie bombing of a Boeing 747 that killed 270 people is in U.S. custody. He's been identified as a former Libyan intelligence officer. The U.S. calls a suspect a third conspirator in the attack, saying he helped build the bomb that destroyed Pan Am Flight 103 over Scotland. Germany's Chancellor Olaf Scholz will host a virtual meeting of the Group of 7 leaders today to discuss Ukraine's immediate needs. That's following Russian missile attacks on the country's energy infrastructure. Meanwhile, President Biden spoke to Ukraine's President Volodymyr Zelensky. The White House says the president affirmed the U.S. commitment to keep providing military and economic aid. In the UK, the government is planning for military staff and civil servants to cover for striking rail, health, postal, and other workers. Strikers are planned for almost every day through the rest of the month. Workers are demanding pay hikes that keep up with inflation. It's the biggest wave of industrial strife in the UK since the 1980s. It's Amgen's biggest acquisition ever. The biotech giant has agreed to buy Horizon Therapeutics for $27.8 billion. That represents a 48% premium since the developer of autoimmune disease treatments disclosed it was in talks with 3 potential buyers. Both Sanofi and Johnson & Johnson unit dropped out of the running. And Rivian has scrapped plans to make electric vans in Europe with Mercedes. The agreement was just signed 3 months ago. Rivian says it will focus on its own consumer and commercial vehicles. It has been a tough first year of production for the company. Rivian lowered its full-year output goal and then had to recall almost all the vehicles it had built for a minor defect. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Stages of a sustainability revolution that has the magnitude of the industrial revolution coupled with the speed of the digital revolution.
Nobody covers climate change like Bloomberg, your global business authority. The top names in business are on Bloomberg.
I think you have to assume that we have some bumpy times ahead, and you have to be a little bit more cautious with your financial resources, with your sizing and the footprint of the organization.
So what can you do near term? Test to make sure you see at the margin you can move things around, manage your expenses very carefully and invest in efficiency and effectiveness, but also continue to spend money where you have competitive advantage.
Nobody covers business like Bloomberg, your global business authority. In a multi-trillion-dollar industry, there's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. It's a big week for the U.S. economy, and Bloomberg's got you covered.
My head's spinning here.
First, tomorrow morning, CPI data comes in.
We're seeing things work themselves out.
This is going to be a really choppy ride.
Then on Wednesday afternoon, a special surveillance will cover the Fed's last rate decision of the year.
Power of that Fed speak is declining.
Does this Federal Reserve have the commitment to keep going?
The question is, how high do they have to go?
The CPI report tomorrow morning and the Fed decision Wednesday afternoon. Right here on Bloomberg, your global business authority.
Long-term structural imbalance between supply and demand globally is not going away. And yes, we have, for the moment, dodged a bullet with regard to the start of winter and the Ukraine war, but we're not addressing the long-term issues of bringing more infrastructure to sate growing demand. The narrative has shifted to a point now where it's moved away from supply, which has been the real bullish driver, and now it's a demand picture.
Stephen Schork there, principal at the Schork Group, in the last hour on Bloomberg Surveillance. Thank you for being with us live from New York. Let's get you some price action quickly. In the equity market on the S&P and the Nasdaq pushing just a little bit higher by 1/3 on both of those. In the bond market, yields are lower by 3 or 4 basis points. 353.97 euro dollar into the ECB on Thursday for the one side of the trade, into the Federal Reserve on Wednesday for the other. Euro dollar 105.63. And to finish on crude, just a turnaround here in the last, I would say, 20 minutes or so. Crude now positive by 0.75%, briefly on a 7-day losing streak. Looking to snap that now with WTI crude at 71.50, Tom. The lower the session, $70.25.
Yeah.
We came very close to the 60s a little bit earlier.
And we are very fortunate to have with us now Will Kennedy for any number of reasons. We've got 8 ways to go here, John, but let's do it with Will Kennedy running all of our hydrocarbon coverage out of London. Kennedy, making every penalty shot he did in his ute in school, joins us. Will Kennedy, let me go to the society of it, the public of it as well. Between cold weather and strikes, how frozen is the London and the United Kingdom economy now? Is it something you're writing about of crisis, or is it just partly December?
I think people are just going to start Christmas early. They're going to stay at home for the next 10 days.
obviously work very hard from home and then, just get through the Christmas period. Yes, it's very hard to move around London right now. It's very hard to move around the UK. A lot of people are meant to be having Christmas parties this week, and that's not happening in many cases, so there will be an economic hit. So time for a bit of hibernation, I think.
Oh, it sounds good. Will Kennedy, Javier Blas writing today about something I've really focused on, which is we have all this fancy Bloomberg surveillance talk with a war going on. After the war, can we repair a European relationship with Russia?
Well, Javier thinks that it's likely. He thinks that economics and proximity mean that the gas will flow eventually. I'm a little less sure, perhaps. I think a lot of people would point to the political unity, to the feeling that, it would be impossible to do business with Putin again. I think most people's view would be that as long as Putin's in the Kremlin, it'll be very hard to resurrect that gas bridge. But that means some tough times ahead for Europe. I think as we go into next year, what's abundantly clear is that a lot of people thought this might be a short-term crisis, but 2023 looks pretty tough on the energy front as well. So those political pressures that Javier described are not going to go away anytime soon.
Well, the Europeans are talking about a multi-winter crisis, Will. Could you help us understand how the Europeans will achieve next winter what they achieved this winter? How do they get storage capacity, get capacity up to where they want it to be, get storage up to where they want it to be, without Nord Stream available to them next year, Will? How's this going to work?
It's going to be tough. Clearly, paying top dollar for LNG supplies is going to be a big part of the picture, and of course Germany will have the ability to import LNG in a way that it didn't in 2022 with new terminals opening up in the north of the country, but that will be incredibly expensive and of course have knock-on effects through the rest of the world. Demand destruction is clearly part of a picture. I mean, I think there's a lot of focus on storage, but one of the reasons why we're getting through this winter, albeit at a big cost, is that we're just using less gas, and a lot of industry has worked out how to use less gas. And slowly and at the margin, investment in other forms of energy, particularly solar and wind, and I know that there are problems with intermittency on some days, will start to fill some of that supply gap for electricity.
Well, when people ask you about China reopening, what do you tell them about how it might potentially complicate the flow of energy around the world?
Well, what's sort of slightly mystifying about the recent price action in crude that you described at the beginning, this really big slide we've seen, is that this end of COVID zero should, on the face of it, be quite bullish for China. It will eventually mean people driving more, flying more, and it's the last piece of pandemic lost demand to be refilled. And it looks like that's going to happen in early 2023, but it's not happening quite yet, and I think there are a few reasons for that, one of which may be that, the road to COVID zero could be very bumpy indeed, and it's a bit early as you consider your positions at the end of the year to take a position on what it means.
So your reporting is China will not open up to the end of the year?
No, I don't think that's the point. I don't think that's the point that I'm making. Clearly, COVID zero is happening. The end of COVID zero is happening, but if many people get ill in the interim, that's not necessarily good for the immediate prospects for the economy. It could be a bumpy ride before China reaches the point that the US and Europe has reached towards the end of the pandemic.
I look, Will, at where we are sort of year end in, and what we're, sitting on our desk, we had a lot of people with higher oil prices. The demand did not materialize. And we focus on Ed Morse here of Citigroup, who was really brilliant about a call to the 70s. Is anyone framing out a persistency of under, say, $73 Brent crude, of West Texas Intermediate under $69, $68?
I mean, a lot of people are cutting their predictions right now. A lot of people are less bullish than they were. And I think it's not so much the demand side. I think what has probably surprised people is the supply side. And obviously the big event in the oil market was the introduction of European sanctions on Russian crude on December the 5th, earlier this month. And I think one of the things we're seeing now is that that event did not have the impact on the market that many people expected. Right now, the flow of Russian crude is being reordered, but it's still happening. It's going to Asia. China's buying, India's buying, Russian production remains high. And I think that's probably one thing that a lot of people got wrong about the market. They expected big constraints in the flow of Russian crude, and they haven't happened. And I think that's changed the balances, and is perhaps one reason why prices have remained very subdued. But one thing that we don't know is what the Russian response will ultimately be. We had those comments from Putin at the end of last week in that when he teased that he might consider cutting production as a retaliation. We'll have to see what happens there.
Will Kennedy, well, wonderful as always to catch up with you and the whole of your team over in London on crude. It's been amazing to see crude gap lower than the way it has done, Tom. Bit of a bounce this morning, up 1% now on WTI, but the previous 6 days, lower.
It is the shock of the year. There's no question about that. You know, there's other things. Curve inversion, I think we're there now, negative 80 basis points as well. You know, we don't have Maria with us today. She's still in treatment for the Spain loss, but you know, I read the articles in the media, including Bloomberg, Kevin Whitelaw writing it up for Bloomberg, on bags of cash. And you have alluded to this over the years, and we're trying to do it, folks, in a journalistically responsible
way. Let's see how this goes in the next 60 seconds.
But the European Parliament, and one of their leaders,
a vice president,
Kylie of Greece, do you know her? Like, is she visible?
From about maybe 7 or 8 years ago when I was in London, sure, through the Greek crisis.
These articles don't mince words. Bags of cash.
So let's be really specific.
Yeah.
Arrested in an investigation into a suspected bribery by a Gulf state. That Gulf state hasn't been named. People suspect it's Qatar. A Qatari spokesperson said he was unaware of any investigation, denied misconduct, as you might expect the line to be. What's happened as a consequence, I understand, Tom, this lawmaker, Eva Kaili, has been suspended by the Parliament's Socialist and Democrats group and expelled from the Greek centre-left PASOK party as well. What they found was cash worth about 600,000 euros, Tom, seized by Belgian police in 16 searches in Brussels on Friday. So, I mean, I don't have the clarity either or the detail.
Yeah, I don't think we do.
And this is all I've got so far. So this story's been pieced together piece by piece over the last couple of days.
So much for the World Cup glow. You know,
well, I mean, it depends who it involves, right? We haven't got confirmation of that.
That's true.
From New York, futures up. This is Bloomberg.
Bags of cash.
watching and says, I want to be Ari Emanuel when I grow up, what should somebody do to get into the talent agency business or the business you're in?
Well, it's hopefully what I've taught my kids. You got to be intellectually curious. You got to be You got to show up, and you know this like I know this. I got on a lot of planes. Even though that voice in your head is saying, "Oh God, I'm so tired. I don't want to do this." You got to show up. You got to be charmingly relentless. You have to build emotional endurance, because there's no straight line to success. It's kind of all over the place, and you have to just be able to work through those things. And then I think one of the things that I do every week is I try to create serendipity.
Welcome to the world of decentralized finance.
I'm going to take a look right here at regulation.
We are seeing digital currencies under some pressure.
Bloomberg's covering all things crypto. The people.
I want to have some of my money outside of the sovereign.
The transactions.
It all comes down to the details here.
And the technology.
How does that affect disruptors like you?
What happens to everything that you're investing in when the last Bitcoin is mined?
Bloomberg Crypto, Tuesdays.
60 minutes away from the opening bell. Equity futures on the S&P, on the Nasdaq, slightly elevated, up a third of 1% here on the S&P 500.
Happy Monday.
Yields are lower by 3 basis points on a 10-year 354. If there's a turnaround so far in this market, it's come in the commodity market for crude, because crude was lower for a 7th session. It's now higher by 0.7%, Tom. $71.50. Big weekly loss on crude this week.
I'm glad you bring it up.
Biggest weekly loss since April last week.
I'm looking at red zone, green zone on the Bloomberg Commodity Index, and going back to September, and frankly, you could even talk it up back to July. It's sort of been up, down, up, down, up, down, and now it's bouncing off the bottom. Like you say, it's been a little bit of a commodity lift.
Just intriguing to see it in the low 70s as China reopens.
Are they reopening? That's the question.
To hear the chief medical advisor of China compare Omicron to the flu, I would say, Tom,
they're on their way.
It's a bit of a turn from the Chinese in the last couple of weeks, that's for sure.
Well, there's no question about that. The other thing we're looking at, of course, is the inflation report tomorrow, and I think to slice and dice that, John, is tangible. This is not just one report. Powell Wednesday will probably feature other inflation series besides what we see tomorrow.
Well, it's intriguing, Tom, because he said there was no space for nuance at the last news conference, and then at Brookings he used a lot of nuance and started chopping and dicing it 3 different ways, services, ex-shelter. So we'll see what kind of Powell we get. Do we get the Brookings Powell at this news conference? On the one hand this, the other hand that, ton of academia, all that kind of stuff.
He doesn't kick the ball over the crossbar.
Oh, another dig at Harry. Nice. Is that how you welcome our next guest?
It is. You know, they score their penalty kicks at Newcastle.
Ian, welcome to New York from England. And
Shepardson, your chief economist at Pantheon Macri. So we'll get to the soccer talk in a bit. What is the distinction? What is the nuance of tomorrow's inflation report, or for that matter, the reports plural of the coming days and weeks?
We're going to see something that looks a lot more like the last one than the two before that. So Powell's been very clear that one good CPI report, one good anything report isn't going to change his mind. We've got to see a sequence. If you look back over the last couple of years, we've had good numbers that got everyone excited, and then the next month we get blindsided by a rebound. And that's happened over and over again. So we've got to see a sequence of decent numbers. Kind of no matter what comes out tomorrow, they're going to do 50 basis points at the meeting this week. It's really what matters over the next 2 or 3 reports, building up a picture by the end of the first quarter where we may be sitting on maybe 3 or 4 good reports. And at that point, the Fed's in a very different place.
Your voice sounds like Alan Greenspan late in his career here. Can you tell us about Harry and the Shepardson voice? Is this like a weekend effect?
It may be connected. There was a lot of shouting over the weekend.
There's a little bit of correlation.
My voice survived.
Yeah.
Saturday. That was brutal.
And I heard a TV remote was remoted.
The batteries might have come out and exploded against the wall, but these things happen.
These things happen. Okay. Let's continue. And if you can't talk, we'll do sign language here. Let's like the dots. What are we going to see in the dots? Is that the sign language of the Fed meeting?
We're going to see more dots, but the dots are a lot less important than they used to be. They're data contingent. Everybody is a slave to the data. The Fed, the markets, everyone. So, the dots are going to rise. They'll probably add in 1 or 2 more hikes for 23, so possibly a 5 handle. But of course, if the next 2-3 payroll reports are weak and the next 2-3 core CPI reports are weak, then the game changes no matter what the dots say.
In early this year, and I remember the report, read through the report, you said that by the time we get to September, the slowdown in this economy will be so obvious, this Fed would have to back away. What surprised you about how things actually turned out? Was it the fact that the economy held up, or the fact that the Federal Reserve has tolerated the weakness that you've identified?
It was a bit of everything. I think they haven't put as much emphasis on the weakness of the housing market as I thought they would, because housing's in total meltdown, and they've been very resistant to buy into the idea that that's symptomatic of any broad sort of weakening. Plus, we've seen a more sustained increase in rents, which is a big chunk of the core CPI. It's now rolling over, or beginning to roll over, but as of now, the last few prints have been quite big. And the margin expansion, which has driven up inflation more broadly, although it is clearly now beginning to reverse on the back of this improving supply story, it's been a bit more persistent than I hoped it would be. So it's kind of a 2 or 3 things around the edges. But looking forward into next year, I think it's very dangerous to assume that what's happened over the last few months happens again over the next few months. There's a lot more signs now of a pretty clear inflection point in both the growth and the inflation numbers. So, for example, we're starting to see a pickup in layoffs now, which we just haven't seen at all. Started in tech. Now it's broadening out at the same time that we're seeing indicators of slower hiring as well. So the payroll picture, which has been great, looking into next year, looks a lot more softening coming through in the first few months.
With all that in mind, how high do you think the bar is to cut rates?
Well, the bar to cut rates is about the labour market, the inflation numbers, and wages. We're not going to get rate cuts until all 3 of those things are materially different from where we are now. So, yeah, they can slow down the rate hikes already because of what's happening on the inflation side, but they can't cut until the labour market is really eased substantially. Wage growth at 5% or thereabouts, no way are they cutting rates, because there's no one at the Fed who could plausibly argue that's consistent with 2% inflation. So that's the final piece of the jigsaw. It'll be the last piece to change, but I think it might change a bit quicker than markets expect.
So where do we settle if we're going to become unanchored, if we're not going to get to 2%? I'm not predicting that, but if that's the reality, what's the level of inflation, which is not your new 2%, but where they have to make some really difficult theoretical decisions?
Yeah, so this is a very difficult debate for them to have while you're above the target. Saying anything other than we're going to get it back to the target is impossible. But there is, of course, a body of opinion. I'm not sure I'm with it, but there is a body of opinion that says structural forces, geopolitics mean that returning to those 2 or less that we were seeing consistently before COVID will be very difficult, at which point the Fed will have to have a serious conversation about whether the 2% target is still appropriate. But they can't do that while they are fighting to rebuild their credibility after the transitory fiasco.
They haven't done that yet. With his effort at Jackson Hole, what was it, an 8-minute speech?
8 minutes, direct, pretty blunt, straightforward.
Jackson Hole and beyond has not repaired the transitory challenges.
Not yet. I mean, inflation is still too high. I mean, there's no way around this.
Of course it is. It's not their fault, though. I mean, we had a pandemic.
It's not their fault, but it was the way that they dressed it up as being transitory. If they defined transitory as 18 months, we wouldn't have had any problem, but they didn't. So there is still a battle to regain credibility, and while you're fighting to regain credibility, you can't even hint of a hint that you wish the target was a bit higher. But they might have to down the line.
12 months ago, when the Fed came out with forecasts for the following 12 months, they had Fed funds at 90 basis points to end 2022. We're going to end closer to 5%. With that in mind, how much should we pay attention to the projections that come out on Wednesday? This is something that frustrates Tom a lot, and others too. How much attention should we, how much weight should we put on those projections?
Well, if you're trading fixed income on the day of the meeting, it's all you care about.
Sure.
But if you're thinking about where the Fed is actually going to be 6 months or 12 months from now, you need to take your own view on where you think the data are going to go. Because they can say whatever they like, they can put whatever dots they like into the plot, but they'll do what the data tell them to do ultimately. So the decision for this week is baked in. But immediately after that, when we're looking at February 1 for the next decision, between now and then, we've got CPI reports, PPI reports, payroll data, wages data, everything. And those things can begin to move them away from the dots immediately. Because the fact is, we don't know. This is why Powell keeps telling everyone we have to be humble, we have to be nimble, we have to be data dependent. The days when you can sit in the middle of an economic cycle and say, yeah, tomorrow's just going to be like today, it's fine, we know it's going to happen. That's not where we are.
So when you think about the dots, and this is hard to get a Fed official to really be transparent about this if they did indeed think the following way, do you think those dots are to signal where they want to tell people where they think they'll be to get financial conditions to tighten now? Or is it actually a best guess of where they think they'll be?
Yeah, well,
because there's a difference there,
There is a difference, and there's a bit of both depending on the circumstances. Depending on what markets are saying, if markets are not where they want them to be, then it becomes a game of psychology. And I can understand that, because the last thing they want is to find financial conditions running ahead of where they want them to be, which means that they might then not be able to do what they think they're going to be able to do. It's very much a catch-22 for policymakers, because markets are so attuned to every little change of nuance or perceived change of nuance that the Fed can find itself generating outcomes that it didn't really want just through the way it communicates.
But I'm going to bring this up, and it's good of you to bring it up today. The Bloomberg Financial Conditions Index, the Chicago Index, the Goldman Sachs Index, they're all running against Powell. I don't understand how he can act to save face until he gets a restrictive summation of financial conditions. We're nowhere near that.
Well, I mean, the only thing you can control directly is rates. And to some extent short-term expectations of rates, and everything else is much more difficult, which is why he's maintained the hawkish talk, though of course there was that shift of the Brookings speech unquestionably, which I guess was because perhaps we're beginning to see some fracturing within the views on the committee as well, and the change in the language in the statement, the talk about lags and the cumulative impact. That's a real change. So he's got to hold everything together, which is not necessarily straightforward.
I found it odd that people didn't think there was a shift at Brookings when there clearly was in the way he communicated. I felt the same way too.
He's been a blank wall until Brookings, and it wasn't that it was a massive shift. It was just the fact that it was nuance. A shift.
And there was some emphasis on the risk of over tightening, and I hadn't heard that in the news conference.
We hadn't. You know, he'd been pretty much a straight arrow in the previous press conferences.
Your voice has to heal. I mean, I guess you're going to do that because you've got Morocco, Croatia in your bracket. But can I ask a question? What happens to the Premier League after this big event? John, you've said this is highly unusual. Is it just back to normal the next day?
My biggest complaint about this World Cup has been the schedule, that the players have had to play a really condensed fixture list ahead of the World Cup, and they'll have to do it after the World Cup as well. And we've seen injuries, and I don't think it's just by accident that we're seeing these injuries start to pile up for some of these big players now who are going to be out.
Well, this is why nobody wanted it in the winter anyway.
Not good.
It was, but you know.
So you're going to come back in January, basically, to answer your question, Tom. You're going to come back. You're going to have a lot of football to play for the big clubs.
Which players did so well in the World Cup they redo their compensation value? Who's worth more now because they did so well in the World Cup?
For England.
Well, no, other teams too.
I think Jude Bellingham's transfer value is just...
Bellingham's probably put a 0 on the end of his
just gone
price.
up again.
Now kind of raise the question of how many clubs could afford him.
I know.
Not many is the answer.
No, maybe Man City. I think Liverpool in the mix for him too, right? From what I hear anyway.
Yeah.
What about AC Milan guy? He looked like a genius at the end of the game.
Giroud.
He's like 45 years old, and he was like,
we'll look after our players in Milan. We'll look after our players.
It was very cool.
Even
I could tell he was.
Who do you support now, Ian? What happens? Who do you support?
Well, for the World Cup.
For the World Cup.
Oh, my interest is gone
just
now.
Indifferent. World Cup finished on Saturday.
When that ball went over the bar, that was it. I just switched off.
That's the World Cup in Cancer finish.
How did the
for everyone in England?
Yeah, for your voice, I recommend Tang.
Tang? Do you have hot Tang, Tom, in the winter?
Hot Tang is
Thank you.
A little squeeze of lemon in it.
Ian, this was fantastic, sir. Yeah. As always. Rest up. I hope the wrist gets better too. Ian smashed the TV. Do you see that? It's got a cast on. It's got plaster on from smashing up the TV. Ian Shepperton and Pandy and Macco. I'm told it was actually a football accident. Futures up on the S&P by a third of 1%. Coming up, Dan Suzuki of Richard Bernstein, Seema Shah of Principal Asset Management, Aaron Cannon of Clear Harbour Asset Management, all in the next hour on Bloomberg TV.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. In China, COVID is rapidly spreading through households and offices after the country's pandemic rules were eased. That's led to turmoil in poorly prepared hospitals. Some facilities are struggling to find enough staff, and others are suspending non-COVID treatments. An investigation into alleged bribery involving European Parliament lawmakers is growing. 4 people, one of them a lawmaker, were charged with corruption and money laundering. Police seized close to $800,000. 2 countries, Qatar and Morocco, were cited in some of those legal documents. In Peru, protesters battled police, leaving at least 1 person dead. President Dina Boluarte declared a state of emergency in several areas. She also plans to ask that the general election be held early. Peru was thrown into chaos last week when President Pedro Castillo was impeached and then arrested after trying to dissolve Congress. Private equity firm Thoma Bravo has agreed to buy Coupa Software for an equity value of $6.2 billion. And that represents a 77% premium to the California-based company's closing price on November 22nd, prior to a Bloomberg News report on its potential sale. Thoma Bravo outbid Visa Equity Partners for Coupa. Microsoft has agreed to buy a stake in the London Stock Exchange Group. The move will give the software company a 4% equity holding, which is currently valued at about $2 billion. The stake is part of a long-term agreement to help LSEG develop data analytics and cloud infrastructure using Microsoft's products. The group will spend about a minimum of $2.8 billion on cloud services over the next 10 years. Global news 24 hours a day, on air and on Bloomberg Quick Take. I'm Lisa Mateo. This is Bloomberg.
Lots happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot.
We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight, with replays all weekend on Bloomberg Television and Radio.
These figures confirm that this is a very challenging economic situation here and across the world, and it will get worse before it gets better. But we have a plan that will more than halve inflation over the next year, and if we stay the course, we can get back to the strong economic growth that we need.
The caution of the Chancellor of the Exchequer there, of course, the BOE meeting coming up later this week. That was Jeremy Hunt. I believe that was taped and filmed before the loss of England. We'll have to see if he has a different tone right now. This is a joy. We will get to the World Cup. We do so with the person I know more committed to American soccer than anyone in my universe. That is Ira Jersey, is Chief U.S. Interest Rate Strategist at Bloomberg Intelligence. And the trap here, Ira, is we got a glorious 10 minutes with you and spent too much of it on World Cup chat, where people really want to know, is head of our U.S. interest rate strategy, what you think about the view forward. Which duration is your biggest mystery into next year?
So I really am worried about the belly of the curve, like what happens with the 5-year and the 7-year.
I'm worried. Go wide here, as they say, Matt, and TV. I'm worried about the belly of the curve as well. Continue.
Because there is a lot of uncertainty about what the future path of interest rates is. So I think what that means is, yes, you might have 2-year yields that stay in the 4.25%, 4.5% range as the Fed maintains its policy. But there's significant questions as to when they're going to cut. So Anna Wong and Bloomberg Economics, myself, and a lot of others think that they're going to remain on hold for all of 2023, maybe into 2024, until it's very clear. And you just heard Ian Shepherdson mention the 3 big things that need to change in order for the Fed to cut interest rates. And those things might not change until 2024, maybe even beyond. So because of that, the 5-year is going to go up and down along the yield curve based on changing expectations of, are they going to cut in 2023? Are they not going to cut till 2025? And that's going to change the expectations that are embedded in that belly of the Treasury
So
curve.
two questions here. One of them has to do with the curve moving from the vanilla curve from 2-year out to 10-year as well. Ian Lingen, among others at BMO Capital Markets, looks for truly historic inversion out to negative 100 basis points as well. What's the ramifications to our viewers and listeners with a beyond Volcker curve inversion?
So during the Volcker era, we actually got to negative 200 basis points on the 2-year 10-year curve. For a cup of coffee, but it stayed for 9 months between negative 100 and negative 150.
Interesting.
I think that that's a reasonable expectation during this environment too. So our target is now about a 150 basis point inversion at some point. It probably is there for, like you said, a cup of coffee.
With the same Volcker-like duration?
So durations are still are significantly longer, actually. But will it stay there for 9 months? You mean?
Yes.
I think that an inverted curve is going to be a fixture for 2023. I think we hit that peak inversion sometime right around the time that the Fed finishes raising interest rates, and then after that we actually start to what we call bull steepen. So 2-year yields wind up going down, because we wind up pricing in cuts at some point in the future. It's the strength of that rally in the front end of the curve that I think is very suspect, because our view is that we're going to wind up with policy rates, with the overnight interest rate staying 5% for a long time. So that's going to make it difficult for 2 years to rally very quickly. But they probably will rally a bit.
Forget about bond guys trading spreads from the belly of the curve out to vanilla 2s, 10s, or even something out like 3 months, 30-year, blah, blah, blah. What's it mean for mere mortals to have a curve inversion like the late 70s, early 80s, a double recession in the early 80s, but it's not the early 80s, is it? So what's it going to mean?
Well, so what does it mean? It means that it's hard actually to make money in carry and roll down. So one of the ways that when the yield curve is steeper that you make money in fixed income is you'll buy like a 10-year bond that becomes a 7-year bond eventually, and the price actually will wind up staying relatively constant or even rise because interest rates fall over time. Now that's not going to be the case now. It's actually just the opposite, where you actually roll up the yield curve. So one of the challenges with that right now is that or one of the good things I should say, it's easy to own 10-year bond yields, because if you buy the 10-year now, in the not too distant future, the price of that bond might actually go up. Which is a kind of an oddity just because of the shape of the curve. I think generally speaking, what does it mean for like the overall economy? It's actually good, right? Because most funding is much different today than it was prior to the global financial crisis. So one of the ironies is that we have 5- and 10-year bond yields that are lower than short term, and it's not going to affect the financial sector in the same way that it has in the past.
What you just heard there, folks, is the single most important thing you'll hear this week on Bloomberg Surveillance and our Fed meeting. Let's dive into this further. Ira Jersey on why curve inversion is quote unquote good for the economy, because it's not like the late 70s, early 80s.
Yeah, so if you think about it, if you buy a car, for example, that's usually say a 3 to 5 year loan. Yes, 3-year interest rates are high, but 5-year interest rates vis-a-vis short-term interest rates aren't very high, right? So you do have an inverted curve just about everywhere. And then if you're a corporation borrowing money, yes, interest rates are higher. We still have 3.5% 10-year Treasury yields, and then you add on to that another 100 or 150 basis points for credit spread. You're talking about 5% yields, which is much higher than it was not long ago. But I'd rather borrow 5% 10-year yields than I would necessarily 6% 2-year. So this inversion isn't having as detrimental of effect. You were talking about financial conditions. One of the effects of an inverted yield curve is that financial conditions aren't as tight as they might be otherwise in real terms, right? So, and I think some of the financial indicators of the financial conditions indicators kind of don't get that wrong, so we're going to actually be digging in over the next couple of weeks into the financial conditions indexes that we have here at Bloomberg. in order to kind of ascertain, hey, not only what's driving it, because we know what's driving it, right? It's the stock market going up is what's really making the financial conditions a bit easier.
Right,
but
as a Greenspan would say.
But what's going on in the credit markets winds up being, I think from on a going forward basis, super important, because if you see credit spreads tighten a lot, that creates more of a problem for the Fed. That just means
Emma's been talking about this like crazy. The spreads haven't moved.
That's right. Spreads are the same, and now that you've had a 75 basis point rally in 10-year yields, that's actually made financial conditions much easier.
MetLife Stadium, 2026 Finals of the World Cup. As John Farrow asked an hour and a half ago, will America embrace the World Cup?
I think so. So I actually was in England during the 1994 World Cup doing my postgraduate work. And coming back from England at the time, all of a sudden people were talking about soccer, which had never happened before in my lifetime. And now I think 2026 could be another impetus to grow the sport even more in the United States, where it is going to be on, everyone's billboards. It's going to be in all the major metropolitan areas in the country. And, where we are here in, New York, New Jersey, Pennsylvania, it's going to be great because we have games at MetLife as well as games down at Lincoln Financial Field in Philadelphia. So we're going to have a lot of great soccer here in our area.
France, Argentina, your wisdom. I mean, you're what is the age group you're in Central Jersey? You're doing what?
I coach an adult team right now. So
you're coaching an adult team right now.
Yeah, we had a big 3-1 win last night to finish our fall season, and we go into the spring on a high.
Who looks more adult, France or Argentina?
Well, definitely Argentina, but both teams have a lot of depth, and I think France with guys like Kylian Mbappe and Olivier Giroud, the man with the greatest hair in soccer and world sports probably.
He looks, I thought Farrell could,
Sure. Those two teams are really good. I mean, it's amazing though the underdog story here, right? This World Cup with Morocco and Croatia in the in the semifinals it would be great to see one of them in it. I mean, I always root for the underdog in matches like those. So it'll be so I'll be wearing my red and white stripes.
Okay, we'll have to see you the Friday before the festivities. I believe it's Sunday the 18th is the finals. We'll be sure to get Ira Jersey in here with appropriate wisdom. Let me give you wisdom on a data check on a Monday before a crucial Tuesday, a crucial Wednesday. I think the world stops Wednesday at 2:30 and we migrate forward. Futures up 9. They've advanced nicely through the day, buttressed up at that 4,000 level John was talking about earlier. Dow futures up 60 points, 33,800 on the Dow. The VIX goes the wrong way, 24.36. We'll get a good set on this here in 35 minutes to Ira Jersey's point curve inversion. I'm still not used to negative 80 basis points, which shows substantial inversion. Jersey suggesting we could get more inversion along the way. In sterling for Will Kennedy. Thank you for being with us, Will, from London. 123, rounded up, 123. Strong sterling today. Please stay with us through the day on Bloomberg Radio and Bloomberg Television. Good morning.
No one covers the world like Bloomberg.
My team thinks 2023, we avoid a recession. I'm a little more skeptical about that.
China and the U.S. both do not want to see nuclear force on the European continent.
The regulators here in the Bahamas are ongoing with their investigation into FTX.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
We've invested more than $10 million in our employees over the past year, and we're going to continue to invest more. We're testing 4-day work weeks to help, especially our working parents kind of juggle that balance between childcare and your work. I know I deal with that all the time. This is really a people-first company. And even in an inflationary environment, you're going to see us continue to lead with our people.
Do you worry at all about a price wage spiral, not just here, but in the industry, in the economy?
Yes, and I think that, this is something that, many business leaders are focused on, and, time will tell kind of how all of this lands.
I think the wage price spiral continues for quite some time, and I think we probably have been a lot less aggressive than we can be, and than many other companies have been.
In terms of raising prices?
Yes, we've taken our time. If you look at the 20-year history of pricing in this company, we've taken about 2% a year on average. We've never taken what we could We've always taken what we should. We have to pay people more. We have been and will continue to do so. We'll take a little bit of a margin compression on that as we've had to, and I think that's the right thing so that for the long term, Shake Shack continues to be what we're building, which is the next generation's burger joint.
You do not get stronger that moment that you're lifting the barbell. You get stronger as your body is making repairs, making recovery. Recovery is a when and how you get fitter, faster, stronger.
Recovery technology includes everything from massage guns and foam rollers to compression boots, hyperbaric chambers, cryo chambers, infrared saunas, and even infrared pajamas. And athletes are partnering to become investors to take those products mainstream.
When you look at tech in sports right now, it's completely innovating the way training's going, completely changing the way recovery's going. I think sky's the limit as far as where it can go.
But while some of these products can feel amazing, it can be difficult to differentiate between what really helps the body and what just tricks the mind.
Every time you're chasing the latest, greatest, newest tool, you're probably chasing a mirage.
We are coming off the back of the biggest weekly loss since September on the S&P 500 and trying to bounce from New York City this morning. Good morning, good morning. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York, we begin with the big issue. Two items on the calendar.
Inflation. In inflation, we are going to get the CPI data.
And then we have the Fed announcement.
What are we going to hear from Chair Powell?
Inflation print will be very important.
The Fed is hyper-focused on bringing down inflation.
We're really not out of the woods yet.
What the market is saying is that the Fed is expected to start cutting rates in 2023.
Inflation is still elevated.
The Fed is saying that they're going to keep rates high until the job is done, until inflation comes down.
Higher for longer.
They're trying to monitor how the economy is reacting to those hikes.
It will all depend on how long inflation is going to be staying elevated.
The Fed is waiting to be, proved right on the inflation side.
Joining us now to discuss is Principal Seema Shah, Dan Suzuki of RB Advisors. Seema, first to you. If you had the choice, what would you want up front right now? CPI tomorrow or the Fed decision on Wednesday?
Gosh, I mean, look, the US CPI, it's important, yes. Do I think it's going to change something about the FOMC on Wednesday? Probably not.
Where's the surprise come on Wednesday for you, Seema? Where's the scope for surprise from this Federal Reserve?
I think it's just simply on what happens at the end of 2023. Do they have any rate cuts? Are they pushing out and saying that there's nothing to come? I don't expect Powell to do too much. We know that he's going to repeat the message about having to. They've made great progress, but there's a little bit further to go. So I think what we're hearing now is, and at least from a market perspective and where the difference in expectations, where the market can go, is really about what happens at the back end of 2023. So I think that's what I'm going to be looking out for.
This tug of war between a market that's saying we're going to see interest rate cuts and Dan Suzuki of Federal Reserve that says, nah, that's not happening. The team here at Bloomberg went through the last 5 hiking cycles. Average duration of just sitting there without cutting rates, 11 months. Over the last 5 interest rate cycles, the average hold of the peak rate was 11 months. Dan, any reason to believe it will be any different this time?
Well, John, I think with a lot of the questions we're probably going to talk about today, including this one, I think ultimately the main driver of answering that question is going to be how fast growth slows. I think that if growth is going to slow really fast, then you're going to see that probably a shorter duration where the Fed stays tight. If it doesn't fall off a cliff, then I think the market needs to assume that the Fed's going to stay tighter for longer. So I think ultimately it comes down to how fast growth deteriorates. At this point, I'm not going to assume that the economy and growth is going to fall off a cliff it's probably going to be a slow grind lower, and which makes the case for kind of a tighter Fed for longer.
Dan, is that shift happening then? Are we shifting our attention away from inflation to growth in a bigger way?
Absolutely. I think, that's probably been the key shift in the markets in the past month, and I think it'll be a bigger shift, going into next year. I think, at this point, obviously we're focused on inflation, the Fed. It's a big week for updates there, but I think more or less the market has it, generally correctly priced, right? Whether the Fed, surprises by 25 or 50 basis points to the upside or the downside over the next few meetings, I think, yes, people will be excited, but when you step back from it, it's really not going to fundamentally matter. So therefore, if the Fed's not going to be the big driver of surprises in markets here, I think it's ultimately going to be growth. And my bias on growth is to the downside, which is why I think it makes sense to still be, focused on defensive areas of the market.
This raises the question about earnings. Mike Wilson over at Morgan Stanley, love this, put it perfectly. This week's focus is likely to be centered on CPI and the Fed. Yesterday's news. He goes on to say it's important for the next week and year-end trading ranges. Sure, the final chapter of this bear market, though, is all about the path of earnings estimates, which for them are too high. Seema Shah, do you think earnings estimates into next year are, quote, too high?
Oh, absolutely. When we look at what we've seen this year, this has really been a year about valuation compression, that ramping up of interest rate expectations for the Fed. Now, as we get into 2023, as we said, the market is generally about right on terms of what to expect from Fed action. But we haven't seen any of the weakness come through in the economy yet. And that's when you start to think, well, look, at some point earnings are going to come down, and that's going to be your second leg to the equity market downturn. Timing is a difficult one to call, but certainly 2023 for us is earnings weakness and therefore further equity market weakness.
So, Seema, super defensive into 23. Is that your stance right now?
It is somewhat defensive, yes, absolutely. I think we've seen a bit of a shift. The US market still looks very, very expensive, especially when you consider that fundamentals are going to be weakening into 2023. So I think there's something to say for some of the other international markets. But generally speaking, yes, this is a time to be defensive and certainly very much about high quality products, which I think takes you back to fixed income at this stage.
Fixed income, get long bonds. Bonds are back. I've heard that so many times. Dan Suzuki, is that what you're on board with into early new year?
Yeah, John, I think first of all, it depends on the type of bonds. In this type of environment, I think you should be moving, to the top of the quality chain. So if you're going to own bonds, I think you want to own them, mostly in long-term treasuries, which I think, there's a few areas over the next 12 months that I think you offer, investors a way to play offense. And by offense, I mean returns of, double-digit returns over the next 12 months. I think one of those areas is probably long-term treasuries.
What's the risk reward there now, Dan, given that we've had an 80 basis point move already from the highs of the year of about 430 down to about 350 on a 10-year already?
Well, clearly, Jonathan, the risk reward is not as good as it was at 4.3, but I think it's still really good here. I think, easily, I think you could see another 100 basis point move down, which is a substantial return opportunity on the long end of the curve.
Dan, that's a deeply inverted yield curve if you're right about a Federal Reserve sticking with it through next year, isn't it?
Yeah, that's right. I think, there's no reason to think that the yield curve won't invert, more from here. I mean, if you think about it, what the Fed is ultimately trying to do is raise the short end of the curve, to slow longer-term growth and longer-term inflation, which by definition almost should bring down, longer-term rates. So I think what you've seen so far is very rational, and it could go further given the Fed's stance here.
Let's work through the consensus for 23. We're doing this every single day, seemingly, at the moment on this program. I go to Evercore's Julian Emmanuel. He's talked about it in a different way with regards to volatility. He says the bear market lacks a cathartic volatility spike present at the end of every bear market since 1970. Such a spike, the bottom, not a bottom, arrives in mid-23 with a lower low as economic and earnings recession forecasts become reality. He goes on to say, the spike ends the decline consistent with length and depth of prior bears, yielding a second half 23 rally to a year-end S&P 500 price target of 4150. Now, you seem to be on board with the first piece of this, Dan, that the earnings recession, the economic pain, the reality of that comes in the first half, stay with bonds. It's the second half piece of it that I want to understand. This idea that we gap lower and then we rally hard into year end because most people believe the Fed has to back away and cut interest rates. Dan, have you got a challenge to that consensus view for the second half of 23?
Yeah, to some degree, Jonathan, I do. I think, if you read that one report in Outlook, I think, that's very much, the story of pretty much every outlook out there. Is a tough first half of the year. You find a bottom and you rally, into the end of the year. I think that's very possible. But I think that, I think where, very rarely have strategists ever as a consensus got it right? So the question you have to ask yourself is where they could be wrong. I think maybe perhaps where they could be wrong is in terms of timing. Maybe, the down leg lower, is a more of a grind. I think if you look at the last two bear markets, they certainly lasted a lot longer than what we've seen so far. And you could get this, particularly when the starting point is one of a bubble, this could take a while for that washout to happen. Again, growth may not fall off a cliff as fast as people think, which may mean that you have a lot more ups and downs, but ultimately higher volatility and lower lows in the market throughout the year. And that may go on through the bulk of 2023. It's possible. So I think, if I think about where the consensus could be wrong, that's one of the ways is really just in terms of timing.
You used the word there, bubble. And Dan, I think you would have enjoyed the conversation I had with Michael Schall of Marketfield a little bit earlier with Tom on Bloomberg Surveillance. He was pushing back against those that are already gravitating to the pre-pandemic playbook. Growth equities, we go back to the old world. And he was suggesting that parts of this market, Dan, might face a lost decade. Parts of this market might face challenges for years and years to come. And by definition, because of that, those parts of this market, which have massive weightings on the S&P 500, that the index story of the last 10 years will fail to repeat through the next 10 years. Now, Dan, it's difficult to get out to next week, never mind the next decade, but can you run me through how you're thinking about that situation?
Jonathan, you took the words right out of my mouth. I think that's absolutely the right take to have with respect to the U.S. equity markets, which, again, are so heavily dominated in weight to those areas that, basically are still in a bubble that's deflating. I think, it's if you look at the history of bubbles, a lost decade is par for the course. Remember back in the NASDAQ peak, from the NASDAQ peak, it took you 14 years to make your money back. Why is that the case? Well, you're paying too much for those future earnings. This is still the area of the market that's the most expensive area of the market, still expensive relative to history, whereas everything else out there trades at a huge discount to history. I think expectations are too high. You're not going to see, even in a bull case scenario, you're not going to see the trajectory of earnings growth that you saw over the last decade to justify, that performance. And the one main thing that I always come back to, John, is that bear markets always signal a change in leadership. You can argue whether the bear market's over, but you can't argue that we've had the bear market, we've had the signal. That tells you the next cycle is not going to be led by the same old stocks which dominate the index. But if you look outside of the U.S., S&P 500 type of exposure, there are great long-term opportunities. And I think that's what people are missing out on.
Seema Shah, final word.
I kind of disagree. Look, I think technology, yes, is going to go through a torrid 2023, maybe potentially into 2024. But we still believe in the use of technology in whatever company, whatever sector you're looking at. So we do think that there will be a recovery. Will it be as strong as what we've seen over the last decade or so? Probably not. But I wouldn't term it as a lost decade. I'd just say it's a more moderate pace of growth, especially in line with slightly less easy financial conditions over the next decade.
Dan's got things to say about opportunities elsewhere. We'll pick up on that in just a moment. Dan Suzuki, Seema Shah, sticking with us. Coming up, China, flipping the script.
Will China be in a better economic financial situation 6 months from now or not? And I would guess that they would be. I think the reopening will be bumpy, but over the next 6 months, they're going to do it.
That conversation up next.
Most of us don't spend much time thinking about the grid, the dizzyingly huge system of cables, transformers, and outlets that reliably powers our lives. It's an easily ignored, change-resistant part of the modern world, and and that's the way we like it. But as we move towards less planet-melting ways of producing electricity, the grid is going to have to evolve too.
We are seeing so many countries and governments announcing high targets when it comes to decarbonization and being climate neutral. But this is just one side of the coin. It's not enough to simply generate green energy. We also need to make sure that this is transmitted and distributed to the end consumers.
The grid of today just isn't equipped for renewables. So a new kind of grid is starting to take shape. The supergrid.
When innovation strikes, Bloomberg Technology is there with the news and analysis you need. Every weekday, only on Bloomberg.
Will China be in a better economic financial situation 6 months from now or not? And I would guess that they would be. I think the reopening will be bumpy, but over the next 6 months, they're going to do it. Whether they get to 5% growth or 4.6 or 4.5, I don't think it's going to make a difference from an investment and from a trading perspective. Will it be better than what it is today? And I'm going to make the bet that it will be.
China continuing to downplay COVID. I've read this line about 10 different times this morning. I'll read it again and reread it throughout today. The nation's top medical advisor comparing Omicron to the flu. As the country moves further and further away from its zero COVID policy, the team at Goldman expecting this reopening to benefit Hong Kong the most with a cumulative GDP boost of 7.6%. Damien Sassower at Bloomberg Intelligence joins us now. I'm going to reread it, Damien.
Yeah, please.
Just the idea that China's top medical advisor is now comparing Omicron to the flu. Can you compare and contrast where we are right now to where we were just, say, 2 weeks ago, 4 weeks ago?
It's a complete 180 degrees. I mean, look, it's clear now that China's going to be doing everything it can to stoke growth in 2023. It's clear that it's taking a big, big step back from its COVID zero policy. And so, look, they're right to assume that Hong Kong, and not just Hong Kong, Thailand, Singapore, are going to see massive tourist inflows. But let's just take a step back, Jonathan. I mean, inflation, CPI in China is 1.7%. What is it here in the U.S.? 7.5%? 10% in the UK? I mean, PPI is in deflation right now at negative 1.6. So forgive me if we are underestimating, if this market is underestimating the ability with which China can get that economy ramped up, inflation is going to tick up. Imagine what that means for the U.S. and for Europe in the second half of 2023 if they're trying to fight inflation, right? So that now comes into people's calculus. That kind of muddies the waters a little bit. That's something we're focused on here.
Before we get to the end of 23, let's get to the start of 23. Damien, the history of this in the last couple of years is very stop-start. You try and reopen, you fail, things start to close again. Even without regulation, people just stop moving around. You see it in the mobility data in the same way because infections go up and people are scared about their health. Damien, do you think this is going to be a smooth path? How bumpy is this going to be through early 23?
Well, in reality or what we're reading about in the numbers? Because let's be clear, you can't trust the numbers right now that are coming out of COVID. I mean, they're not testing people anymore. So we're hearing on the ground about massive hospitalizations, about the death numbers they stopped reporting. So it's the same thing with what people say about China's GDP numbers, right? It's like, do you really believe these numbers? Personally, I think, everyone's right to assume that China's going to get what they want out of this. They're going to get 5% growth in the next year. I mean, we're kind of at low fours. But I mean, they're going to definitely do everything they can to stoke growth, and they're going to, sweep some of the data under the pocket to get there, under their kind of rug to get there, I think. So, it's back to what we once thought. China's now in focus for Beijing, and you don't want to really kind of test the PBOC in those waters.
The markets care about change in direction. The change is pretty clear. The direction is pretty obvious at the moment, Damien. So walk me through the big call. How do you play this at the moment? Is it just through what's happening onshore, through the equity market there? Is it somewhere else? What's the ultimate proxy for you to play this story?
Well, I think certainly one of the easiest ways is to play it via some of the periphery Asian currencies like Thai baht, like Sing dollar. But I think, for me, if you just look at equities, I mean, they're so volatile right now. I think the HSCEI volatility index, which is the VIX comparison for China, it's up 50% year to date, whereas the VIX is up, a third. It's up significantly. You really can't play China mainland equities. If you did overnight, you would have got steamrolled again with Baba and Meituan down big. So, it's very difficult to pick your spots. Maybe the airlines, maybe the car companies, the reopening stocks, as it were. But I still prefer to play it via currencies like the Malaysian ringgit, the Thai baht, maybe the Sing dollar.
What a difference a few protests make over a weekend there, Damien, because this accelerated after that, that's for sure. Damien Sasser there of Bloomberg Intelligence, thank you. Just to see that, the top medical advisor in China comparing Omicron to the flu. You would not have heard that several weeks ago, that's for sure. This is the big story right now for many of you I know. Principal Seema Shah optimistic on the reopening, writing the following. The reopening coupled with additional stimulus policies should provide the catalyst for a strong rebound in Chinese economic activity and risk assets in 23. The positive impact should extend far, providing a strong boost to its major trading partners across Europe and particularly Asia. Global commodity prices also stand to benefit from this development. Seema Shah back with us alongside Dan Suzuki. So Seema, can I pick up on the last point, the commodity market point? If that's the case, why did crude just have one of its worst weeks of the year on WTI? What was that about?
God, I mean, I think with the oil market on a week-to-week basis, it's a tough one to call. There's so many other impacts which are going on. So when it comes to commodities, you have to take more than just a kind of even a 6-month view. It has to be a multi-year view. And you have to say to yourself, well, look, if China's going to reopen today, then growth over the next 1 year is going to be stronger than it is today for global growth as well. Throw into that the supply issues that we know face the oil market. And to us, this is an area to have a long-term overweight in.
Good news because the supply constraints ease and demand picks up. Is there a bad news element to this because inflation is stickier off the back of it, Seema?
Yes, absolutely. So, you asked in the previous segment about the outlook for the second half of the year for the US equity market. Well, look, all of this is feeding into higher inflation for the US. It feeds into the idea that the market is getting it wrong about Fed cuts in the second half of next year. So for us, this means that equity markets, yes, they fall in the first half of next year, but do they recover in H2? I would be a little bit more cautious about that. And one of the things that feeds into it is what we're expecting to happen from China. So I do think international markets are looking a little bit more attractive than they were certainly a month or two ago.
I sense that Dan Suzuki is on board. Dan, in your notes, the world is about to enter a profits recession and liquidity continues to tighten. But that's the opposite story from what's happening in China, where profits have bottomed and liquidity is improving. Dan, can you walk us through that just a little bit further?
Yeah, absolutely, Jonathan. Obviously, the market is ultra focused on this reopening story that's been happening. That's why, depending on the market in China, it's up 30-40+%. I think a lot of that story has probably played out. It really, our bullishness on China goes beyond just the reopening itself. Clearly, that's a critical factor in that trajectory. But with or without the reopening, I think you would have this bottoming in profits simply because they had led us into this profits recession. The rest of the world still has yet to follow. And so in that environment, China leads us in. It will probably lead us out. It probably will start in the next quarter or two. And at the same time, they're trying to pump liquidity into their economy by cutting rates, stimulate credit growth, and ease, regulatory policy there. So what's happening in the rest of the world is that we're going into a profits recession and liquidity is still tightening. We're going to be, see another 100 basis points or so of Fed hikes. That's exactly the opposite story in China. And it goes, again, beyond the reopening. And that's what makes China exciting at a time like this, because it sticks out like a sore thumb.
Let's say that optimism materializes. Let's say the reasons for that optimism bear fruit through next year. Dan, what do you want to push that story through? Because Damien was talking about maybe some proxies in Asia and the FX market. What would you be focused on?
Yeah, I think really, for us, I mean, it's not rocket science. I think, if profits growth is going to accelerate, liquidity is going to continue to improve, we're just happy to own the broad markets there. I think that all parts of their economy and their market are going to be beneficiaries of that. So rather than rethink it, I mean, FX sounds sexy, but there's so many other factors that go into that. I think FX is probably one of the hardest things to forecast. So, to take that second or third derivative, I'd rather just take the first derivative.
Well, I think the hardest thing to forecast is crude. I think we often say on this show, Dan, that if you want to make a fool out of someone, ask them where they think crude's going to be in 12 months from now. Dan, the fact we're in the low 70s, I didn't see that coming. Dan, can you make any kind of call on what's happening with the commodity market off the back of this China reopening story?
Yeah, I think, listen, I think there's a lot of support here. I mean, if you look at demand in the U.S., they're probably going to start, refilling that SPR, Strategic Petroleum Reserve, in and around the low 70s. At the same time, you have growth that's not falling off a cliff, and you have China that's reopening. I think that's the support that you have to sort of hang your hat on. At the same time, I said earlier in the show that the number one factor is the speed and rate of change of growth here. If growth just all of a sudden, animal spirits kind of lose out and growth falls off a cliff, you could see a rapid fall in oil and oil demand. And that's why we think rather than own the commodity, I would much rather own, the commodity producers, which are going to be priced more on that long-term outlook for oil, which I think is still positive regardless of the next 12 months.
Well, that's certainly been the story the last 12 months. Dan Suzuki, special thanks to you alongside Seema Shah. Absolutely brilliant, the both of you. Thank you. In your equity market right now in the S&P, we're about 7 or 8 minutes away from the opening bow. We're positive by 1/3 of 1%. Coming up, the morning calls and later, both Morgan Stanley and Goldman warning of an earnings downturn. That conversation still ahead with Clear Harbour's Aaron Kennan around the opening bow. From New York City, this is Bloomberg.
China's military power has been growing at an incredible speed over the last 20 years.
A strong country must have a strong military, as only then can it guarantee the security of the nation.
In terms of sphere of influence, we absolutely know that China wants to be dominant in Asia. So there is a target to get to that point, to be a military that is a peer to the greatest militaries in the world by 2035.
The competition for influence is a global one. And through a multi-decade trajectory fueled by planning, money, and pragmatism, China is building a military that allows it to shape the 21st century just as the U.S. shaped the 20th.
About 5 minutes away from the opening bow, trying to bounce back here from a pretty big weekly loss last week on the S&P. Futures up by 1/4% on the S&P, on the Nasdaq up by a little more than 1/10 of 1%. That's the price action. Let's get you some morning calls. First up from Goldman, upgrading Best Buy to neutral, $83 price target. The analyst citing the ability to maintain market share and a healthy inventory position. That stock is basically unchanged in the pre-market. Your second call from the team over at Wells Fargo, downgrading Qualcomm to underweight, 105 price target, expecting continued underperformance from smartphone names. That stock is down by a little more than 2% at 116.56. And your third and final call from Stifel, upgrading Under Armour to buy, $12 price target, saying inventory discipline is creating better certainty on margins. That stock is up by more than 4% in the pre-market, $9.95. Coming up, the next shooter drop, it's earnings estimates. The growing consensus on Wall Street is they are too high. Why Clear Harbour's Aaron Kennan thinks it could drag the S&P down to 3K. That's next. This is Bloomberg.
After hardly a full year of name, image, and likeness deals being a reality, UCLA quarterback Chase Griffin already has more than 20 deals with major brands, venture, and charitable groups, all while balancing graduating undergrad in just 2 years and fighting for playing time on the field.
Chase Griffin out of the gun.
We are joined by UCLA quarterback Chase Griffin, not just UCLA quarterback, but name, image, likeness superstar. I am psyched for this one.
This kid could actually be the president of the United States someday.
When it comes to building generational wealth, it's not about the money that you make in college. I'm very excited that I made the amount of money that I made last year. I am even 10 times more excited that I know how to make that money.
A lot's happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot. We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
Coming off the back of the biggest weekly loss on the S&P 500 since September, trying to bounce going into two key risk events this week. CPI tomorrow, the Federal Reserve on Wednesday, and I'm sure you're sick to death of hearing that already. Equity futures right now positive by a couple of tenths of 1% on the S&P, on the Nasdaq 100, basically unchanged. Let's see opening bow switch of the board and get to the bond market. Yields shaping up as follows on a 10-year, down by 5 basis points. So a 10-year right now, 352.87 in the FX market. Euro dollar 105.58. We're positive there by 0.2%. And crude this morning was down for a 7th straight session. Now trying to bounce up by 1.4%, call it 1.5. $72 a barrel after coming very, very close to breaking into the 60s. About 20 seconds into this session, the S&P 500 positive by 0.2%. The Nasdaq up by a little more than 0.1%. One stock to watch at the open, Horizon Therapeutics, the company getting a bid from Amgen, a $27.8 billion price tag pushing the stock higher. Kelly Lyons has more. Hey, Kaylee.
Yeah, John, this is a big deal, big merger Monday. This would be Amgen's biggest deal ever, and obviously you are seeing the result of Horizon Therapeutics shares moving higher. Amgen, though, a little bit lower. Now, Amgen's argument here is that these portfolios complement each other. Horizon's portfolio includes a therapy for an autoimmune disease called thyroid eye disease, and that is a condition that apparently is pretty painful and can provide billions of dollars worth of revenue. So Amgen says overall this will provide a sales boost globally. Analysts, though, have kind of mixed feelings. Wells Fargo says the deal doesn't pass the test of Amgen's current needs. RBC saying it could take time to get a handle on the portfolio and is questioning the size. And on that size, that $116.50 share price tag is a 20% premium to Friday's close, a 48% premium to November 29th, when Horizon first disclosed that it was in early talks with 3 suitors. Because remember, Sanofi and J&J also initially were in the running. They both dropped their bids, with Sanofi yesterday saying that the price tag had just gotten too high because the stock was trading sub $80 2 weeks ago. This morning, it's now trading up at 111, so even still shy of that deal price. But that is a 43% move in just 10 days. And what's interesting, John, is I would note this is not the only deal this morning. You actually have about $70 billion in deals announced through Sunday so far this week. So an interesting rush to get these things over the finish line before the end of the year, considering it has been such a slow year with deal volume down by about a third in 2022, John.
It has been so quiet, and investment banks want to see way more of this stuff next year. Kaylee, thank you. As always, Apple, another one to watch, getting a fresh dose of optimism, that's for sure. China lifting its high-risk COVID status in the area surrounding Foxconn's iPhone plant. That stock is up by a couple of tenths of 1%. Ed Ludlow has more. Hey, Ed.
Yeah, good morning, John. We're modestly higher, right? 0.2%. You're right. This is the Zhengzhou Airport Economy Zone, where basically Chinese authorities have decategorized that area as high-risk COVID zones. Therefore, we're getting optimistic, and a number of sell-siders have notes out about how this could improve production at the facility, which accounts for 4 out of every 5 iPhone 14 Pro handsets that are made. Citi has a note out having met with Hon Hai Precision, or Foxconn's management in investor meetings last week, saying that the commentary from them is that production will normalize this month, in the month of December. There are cautions from others. Oppenheimer, for example, cutting its price target to 170 from 190, saying that actually iPhone production capacity recovery in China might come a bit later than that. You look at what's happening in China right now. There has been a reaction to the easing of COVID restrictions, with cases spreading. There's been reporting on the Bloomberg terminal about how hospitals are struggling with that. Interesting table on your screen. Bloomberg's done an analysis of Taiwan-based iPhone or Apple suppliers and assemblers. Actually, in the month of November, across those names, revenue fell 6.4% in that month from a year ago. It's the first monthly sales drop for the group since April. So you kind of get that sense of the lingering impact that these disruptions from COVID in China have had for those assemblers, and the concern we still kind of have around Apple being able to produce the handset that's in demand, the Pro models.
Ed, since we went to China and production, let's finish on Tesla. It's down again today by about 2%.
Yeah.
It was down last week, down by about 8% last week. Didn't have a great week at all, Ed. What's the latest for people in that stock?
Yeah, so there was a lot of debate about whether a pullback in production in Shanghai was related to sort of annual standard maintenance, where you shut the assembly lines down in order to update them and upgrade them. That is something that Tesla has in the past timed to the Chinese New Year, which falls in January, but Bloomberg reported this is an action Tesla's taking right now. Bloomberg also reported that they were cutting the shift hours from 11.5 to 9.5 in Shanghai, and stopped onboarding new assembly line workers. So what I'm hearing from investors, what you see in the sell side notes as well, is they just want something from Tesla, from Elon Musk, from management, just to say, is this a demand issue, so you're pulling back, or is this just standard practice to pull back the assembly line? We don't have anything from Tesla, and that's part of what the concern is around the stock. That, and of course, the kind of lingering effects of Musk's financing package to buy Twitter.
We were both asking the same question through last week. It is the question right now for what's happening in China. Ed, thank you, buddy, as always. Looking forward to the coverage a little bit later. The stock for Tesla down by a little more than 2%. The broader equity market concerned about one thing, what happens with earnings in the first half of 23. You know the growing consensus on the street right now. An earnings downturn is coming and will bring the S&P down with it. It's the view from Morgan Stanley's Mike Wilson, writing a final chapter to this bear market is all about the path of earnings estimates, which are far too high in our view. From Goldman's David Kostin writing the following: earnings could fall next year due to more margin compression than we expect. And from Clear Harbour's Aaron Kennan, who writes the following: there exists a rising probability that we see earnings falter in 23. This would create an environment of rising downside risk for equities for the year. A more pronounced recession with earnings following that trend could see the S&P 500 closer to 3,000. Aaron, I'm pleased to say, joins us right now. Now, Aaron, there was a lot of coulds, maybes, ifs. Let's talk about some of them. How much earnings pain are you forecasting for early 23?
Right. So, John, thank you. Good morning. Our base case is for a lackluster earnings picture, but it's not for the 3,000 number. We think if you look at consensus, if we end the year at 221 earnings per share for the S&P 500, which looks like it's sort of in the cards at this point, estimates right now across Wall Street are about calling for about $230 of earnings next year. On average, 1 year forward, those earnings estimates tend to be inflated relative to reality by about 7%. So that takes us back down below 220 to, let's say, 217, which is essentially a flat earnings year for 2023. That's sort of my base case, sort of with my strategist cap on. But there is a thesis, of course, that if we enter a recession, and earnings we know peaked probably in 2021, margins peaked in 2021, and growth looks lackluster for this year, that, there is a thesis that we could see a 15% decline in earnings. And if you put a multiple at trough on that, at 14 or even 15, that takes you to 3,000 or less. It's not our base case, but we're very mindful that that's a risk out there in the market.
We always hear about a low versus the low. I think we heard it from Julian Emmanuel of Evercore over the weekend in his note, and he said this, and I'd love your thoughts on it, Aaron. He said the bear market lacks the cathartic volatility spike present at the end of every bear market since 1970. Such a spike, the bottom, not a bottom, arrives in mid-23 with a lower low as economic and earnings recession forecasts become reality. Aaron, could you explain what was lacking about the low that we've seen so far through 2022 that doesn't make it the low of this bear market?
Well, it may indeed be the low, and I certainly hope that it is. But we have an inflation picture that is still unclear to investors, unclear to the Fed, and we have an employment picture which speaks to maybe some softening there on the margin. And the outcome for geopolitical uncertainty, whether it's the energy impact on Europe and the ability for Europe to even function from an industrial perspective due to massive input costs, the uncertainty on the picture in China, as you already referenced this morning. There are a lot of variables out there, a lot of sort of fat tail risks, so to speak, that will impact this market. And so the notion that we're going to end the year unchanged almost seems like a silly one, given all of the pronounced volatility that we're seeing around the capital markets landscape.
The dip and rip, we've heard it a million times, haven't we? You and I both over the last month. You dip in the first half, you rip in the second half as the Fed has to back away. I was going through your risk factors for next year. The number 2 risks, year next year, one by one, I'm going to go through them with you. Elevated inflation for longer was 1, and 2, a more pronounced recession with earnings following that trend was 2. So we've dealt with 2, let's deal with 1. Elevated inflation for longer. Aaron, from your perspective, what is elevated? Is it 3, is it 4, is it 5? What is it? What's problematic?
Right, well, the long-term inflation expectations are, below 250 if you look at 10-year break-evens. And we have inflation in the short term that's still extraordinarily pronounced. And you have the PCE data point, which the Fed really looks at, that deflator. And if you look at PCE at 5 with a 5% handle on it, we've never seen PCE drop 1.5 percentage points to even that 3% type level, or 3.5% type level. Never mind 2 and 2.5, unless we've had a recession. We haven't seen that since 1970. And so that's where, while I believe inflation expectations are going to come down nicely this year, I think there's a lot of reasons to believe that. You look at the Goldman Sachs Commodity Index, it's down 30%. You look at rents, they're starting to soften. You look at M2 money supply, it spiked 45% in 2020, 2021. And what's it doing now? It's actually at a negative annualized pace not seen since the 1930s. So I have, in my base case, inflation coming down significantly. But I look at that PCE number, and without a recession, it's hard to see PCE move back down towards the sort of break-even 2.5 type level that we're talking about. That just gives me a little bit of pause on the margin.
Does that complicate life for those that make up a growing list of bond bulls that have spoken to me in the last month, Aaron?
I think for the first half of the year, even we will see inflation come off, and I think that it probably bodes well for continued curve inversion. It probably bodes well for the Bloomberg Aggregate Bond Index continuing to probably rally from this point forward. But it's certainly in the latter innings of trying to make it back down towards that long-term inflation level, whether it's from 7 to 5 to 3 to 2.5. I think that the last couple of innings there is going to be a great debate. I'm not sure that's going to be a debate for 23, maybe more of a debate for 24, for us to be able to see a 2-handle on long-term inflation and short-term inflation expectations.
A final question, equity leadership 2023. I've had this debate all morning. Where does the equity leadership come from, and what goes into that calculation for you?
Yeah, it's really interesting, right? Price is so important, and I think we sometimes fail to think about price. So value has outperformed significantly growth this year, but at a price in certain components of value, right? You look at the financials, you look at the industrials, you look at consumer staples. They're not cheap, particularly staples. Energy remains cheap, so there are components of value, healthcare, that look still quite attractive. But then there are components of the growth, and I mean growth that has earnings attached to it, not growth at any price. And I think growth has corrected so significantly that there are some really interesting areas across mid-cap, large cap, and even to some extent mega cap growth going into the future. In a world where growth is going to be hard to come by in the years ahead relative to the last decade or two due to deceleration of population. Maybe we don't have those productivity gains. We're still going to be looking for companies that can capture market share, that can develop goods and services that are in high demand and that can outpace overall GDP growth. And we think this coming year, we're still going to continue to see that. So we think on both the value and growth side, both home and abroad, emerging markets look interesting, particularly outside of China, growing middle class, still significant demand for goods and services there. There's lots of opportunities. One area of concern for us remains Europe, where the industrial area of that economy we think will continue to suffer as long as that war in Ukraine continues, and the input cost of energy and electricity prices remains extraordinarily high and uncompetitive for companies in countries like Germany.
Aaron Cannon, as always, sir, thank you, buddy. It's good to catch up. About 13 minutes into this session, equities basically unchanged on the S&P. On the Nasdaq, we're down by close to 0.1%, but no real drama here. You want some drama, some theatre? Coming up, FTX founder Sam Bankman-Fried in the hot seat.
People are trying to determine how much SBF really knew. But at the end of the day, it doesn't matter. He was the CEO.
That conversation up next.
Welcome to the world of decentralized finance.
I'm going to take a look right here at regulation.
We are seeing digital currencies under some pressure.
Bloomberg's covering all things crypto. The people.
I want to have some of my money outside of the sovereign.
The transactions.
It all comes down to the details here.
And the technology.
How does that affect disruptors like you?
What happens to everything that you're investing in when the last Bitcoin is mined?
Bloomberg Crypto, Tuesdays.
Today, what are the biggest challenges for General Dynamics and what are the biggest opportunities?
So I think in any business, the challenges are solving complex problems that come to you. You know, the problems that come to me and my senior leadership team for resolving tend to be highly complex and nettlesome. So your ability to solve those complex problems are an important element, I think, of the value that we add to the company. And then I think opportunities, you always want to make sure that you've got a creative enough mind, an open enough mind to be able to see around square corners. What am I missing? You know, the why questions are really powerful. Why are we not doing this, or why are we doing this? I ask those questions a lot, and in the answers, you can sometimes tease out some real opportunities, some hidden things. But thinking creatively about opportunities and problems is really important.
And what about the industry generally? Do you think they have big challenges now as the defense budget probably comes down a bit?
So I think that we are all responsible, and we have an obligation to find the latest and best technologies that we can for our customers and deliver them in the most cost-effective manner we can. And I think that that's a challenge and an opportunity for all of the big defense companies.
So you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
People are trying to determine how much SBF really knew. I really doubt that he's unaware of much that took place. It did grow really quickly. However, he was the CEO and maintained a really tight grip on everything that took place at both FTX, and then I believe Alameda as well. So I don't think that he can plead ignorance on any of these charges.
The FTX saga continuing to unfold. Bloomberg reporting the US is investigating FTX founder Sam Bankman-Fried for fraud and examining cash flows to the Bahamas. This coming ahead of the former chief's testimony on Capitol Hill. Bankman-Fried warning in a tweet he'll be limited in what he can say. Your team coverage starts right now with Bloomberg's Anne-Marie down in D.C. Matt Miller here in New York. AMH, first to you. Walk us through what this is going to look like in the next 24 hours.
Well, we're still waiting on, John, confirmation if Sam Bankman-Fried is even going to show up in person in the flesh. We should also note he's only going to be at this moment attending the House hearing. He did not respond in time to the Senate request, but those senators in the Senate, like Senator Toomey and Sherrod Brown, they're ready to issue a subpoena if he does not show up. So potentially he's going to be virtually dialing in from the Bahamas, or he will be here in person. We don't know yet. My gut instinct is telling me this will be a Zoom meeting. But you could see from his tweet, he said he is willing to testify, but there was a caveat there. He said he doesn't really have much he can say because he doesn't have access to his data.
Well, there was a comeback from Representative Maxine Waters ahead of that, basically preempting it. She said, based on your role as CEO and your media interviews over the past few weeks, it's clear to us that the information you have thus far is sufficient for testimony. So what is this, Matt? Do we get anything new from this, or is this just the stuff from media interviews on the record to Congress?
Yeah, I don't expect we'll get anything new. I thought it was interesting how polite and kind Maxine Waters was to SBF, considering the size of the losses here. Maybe she's been a little bit nicer because this was an international business and the U.S. investors didn't necessarily lose as much, but I don't know that he's going to tell her any more than he told us. You know, Zeke Fox was down there at his penthouse just a few weeks ago trying to figure out what happened. We all watched the Andrew Ross Sorkin interview as well at the DealBook conference, and he just doesn't seem to either have answers or be willing to give answers. Maybe that's different when you're testifying under oath, but I can't imagine that it is, and I have to vote with Anne-Marie. I'm sure he's going to dial in. He'll be Zoomed to Congress. It seems like too much of a risk in terms of potential arrests if he actually comes in.
Matt, what are the answers that you want that we don't have? What are the questions that you think need to be asked that maybe haven't been asked over the last few weeks?
It just is a question of, as Reeve Collins was saying, whether he knew or he didn't know. And how could he not know if Alameda had $8 billion of margin on FTX? I mean, that seems like something you should be aware of, since he was the full owner of Alameda and he was the CEO of FTX, right? If you're giving someone $8 billion of margin, you probably want to know about that client.
You mentioned the treatment of him, the approach by Congresswoman Maxine Waters. Can you speak to that, Anne-Marie? What do you make of that, and what are people saying about it down in D.C.? Why this almost cozy approach to this individual?
Well, most would look back at the finances, which is according to Open Secrets, Sam Bankman-Fried was the second to the top when it comes to campaign dollars to the Democrats, just after George Soros. So some would say that he was, quote unquote, in bed with the Democrats, and that's why they have kind of gloves when dealing with him. But Maxine Waters, Representative Waters, she punched back on Twitter when there was a report that she would not issue a subpoena if he did not willfully come to this hearing, and she said that is not true. We will certainly issue a subpoena. But there's been a lot of criticism, and not just politicians, Jonathan, but just the media writ large, celebrities, lawmakers, business executives. You have Senator Warren also asking Jerome Powell and other banking regulators if they plan to do a review of banks that were involved in this crypto space following this collapse. There's a lot of people who were signed up and wanted to see him succeed.
Matt, what do you make of it? Well, you mentioned it. What's it all about?
It's, I think, a lot of circus, a lot of theater, and it'll be fun to watch, but I don't know that we're going to get that much out of who did what and who's responsible. The interesting thing and the important part is going to be what we get in terms of the regulatory framework going forward. Anne-Marie mentions banks. A lot of them have issued their own stable coins, for example, JP Morgan, so it'll be interesting to see if politicians want to put that ball in the Fed's court in terms of regulation and how they plan on regulating stable coins. And then it'll be interesting to see for the rest of the crypto market if they want to say, look, these are commodities and the CFTC has to deal with it, or they'll should be treated as securities, and the SEC has to deal with it. They've already got a bill written up, so I think the regulatory side is going to be the most important to markets going forward, even if the kind of whodunit is exciting as theater.
We always frame it as a grilling, and then sometimes it's not quite a grilling. Matt, you know what I'd love? Can we stop calling him SBF? Guy's a name. And the nickname stuff. Sam Bankman-Fried, really serious issue. Let's address him by his name and stop this SBF friendly. He's not a character out of a comic. Do you know what I mean, Matt?
He's not AMH.
He's not AMH, precisely. I've just seen so much of that, Matt. This SBF, he's your kind friend who runs an exchange.
Yes.
Put your money here. It's just, no thanks.
Well, I think that happens. I mean, DSK also was accused of some pretty serious stuff, and I think maybe convicted. Nonetheless, we didn't call him Dominique Strauss-Kahn very often.
Well, I didn't call him DSK. Just my view on style.
But AMH may have.
AMH is great. Alongside Matt Miller, to the two of you. Thank you. Let's get you some sector price action. Here's Kaylee.
Well, John, we are up about 0.25% on the S&P 500. What is leading the charge today is technology, with heavyweights like Apple and Microsoft higher. Tesla, though, creating a drag on consumer discretionary. That's the big underperformer, down about 0.4%. Another group of stocks underperforming, Chinese stocks, or those ADRs here in the U.S. The Hang Seng Golden Dragon China Index down about 2.8% at the moment. You got COVID concerns and chip restrictions as well concerning there, John.
Katie, nice. Thank you very much. Coming up, your trading diary, and I think you can take a guess what's in it. This is Bloomberg.
thinking big from the beginning. I mean, the reason that I was interested in doing this in the first place was a much bigger challenge than making a comfortable shoe or doing something in the fashion industry as a narrow opportunity. We thought that there was a big leadership opportunity. We looked around at an industry where there was 20 billion pairs of sneakers made every single year, and it was 100% made from plastic and the hides from cows, and it was terrible for the environment. And we thought that we could offer something to consumers that was differentiated in the way it feels, more comfortable, higher performance, and do that because we use sustainable materials. And in doing so, we could take a really interesting leadership opportunity and grab that and use that to tell a totally different story and compete on a totally different vector than what the rest of the industry were doing.
26 minutes into the session, equities up by 0.2%, call it 0.25% on the S&P. On the Nasdaq, up by a little more than 0.1%. That's the price action. Here's your trading diary. US CPI coming up tomorrow morning, plus FTX founder Sam Bankman-Fried testifying to Capitol Hill. We get 9 central bank decisions this week, I'm told. You get 1 on Wednesday, the Federal Reserve decision, followed by decisions from the Bank of England and the ECB on Thursday. Then another round of jobless claims that morning as well, and retail sales in America. What a week. And finally, rounding out the week with US PMIs on Friday. From New York City, that does it for me. Thank you for choosing Bloomberg TV. Good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.
Most of us don't spend much time thinking about the grid, the dizzyingly huge system of cables, transformers, and outlets that reliably powers our lives. It's an easily ignored, change-resistant part of the modern world, and that's the way we like it. But as we move towards less planet-melting ways of producing electricity, the grid is going to have to evolve too.
We're seeing so many countries and governments announcing high targets when it comes to decarbonization and being climate neutral. But this is just one side of the coin. It's not enough to simply generate green energy. We also need to make sure that this is transmitted and distributed to the end consumers.
The grid of today just isn't equipped for renewables. So a new kind of grid is starting to take shape. The supergrid.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Businessweek about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands. And it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi-Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in sari stores every day, also on TV, radio, and newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with number fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for number fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, Pepsi goons bomb their own trucks. And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired two consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi Number Fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's Number Fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning 1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as the coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic. They had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack of the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be employed by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker but pretending to be a foreign person.
Federal investigators have detained 1 man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Venegold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Venegold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Venegold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Venegold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony, including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why he may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Weinergold as an opportunity to leave that troubled home. Weinergold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Weinergold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Weinergold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately, Weinergold didn't receive the harshest possible sentence. He was given 14 years in prison, but it's still a considerable amount in jail in Germany.
The threat of an asteroid hitting Earth is very real. If it's big enough, it's also very final.
These are very, very infrequent events. The probability is not zero, though.
A blinding flash of light streaking across the sky.
About 100 tons of space rock falls on Earth every day. Most of it is so small it burns up in our atmosphere or lands unnoticed away from major populations. No human in the past 1,000 years is known to have been killed by a meteorite, and according to NASA, no large object is likely to strike the Earth any time in the next several hundred years. However, one thing is certain: we haven't found them all.
There are thousands out there, and we don't know where they are.
There are a lot of asteroids in our solar system. They number in the billions.
Scientists all over the world are working toward detecting and deflecting the most catastrophic of natural disasters.
The race is on to find as many of these objects as we can.
We have a way of calculating whether or not an asteroid is potentially dangerous or not.
I mean, I think it's something worth investing in. It's our existence at stake, right?
Amy, let's get this one out of the way. It's probably the question you get asked the most, but how scared should we be?
Asteroids and comets are a natural hazard that's out there like a lot of other natural hazards. These are very, very infrequent events, these collision events, where an object actually impacts the Earth. The most important thing that we need to know about asteroids is when the next impact is going to happen and how bad it will be. What we know is that an object that's about, say, a kilometer across is capable of causing very, very wide devastation across the planet, really, truly global devastation. The object that wiped out the dinosaurs was somewhere in the neighborhood of 5 to 10 kilometers across, so even bigger than that. At a kilometer, it's still going to be very bad and will have global effects. For objects that are capable of causing what I would call sort of regional damage, kind of a large major metropolitan area, a city and its surrounding environment, sort of around 100-ish meters. It depends on the details of the composition and so forth.
By the 1980s, NASA was cataloguing near-Earth objects. In 1994, stargazers watched as comet Shoemaker-Levy 9 hit Jupiter. The resulting zone of chaos was estimated to be as large as the Earth, and the event became a turning point in the search for asteroids and comets in our solar system. In 1998, Congress tasked NASA with finding 90% of asteroids and comets 1 kilometer wide or larger. Soon after, Hollywood blockbusters Armageddon and Deep Impact brought attention and fear to the masses.
The great news is that the vast majority, more than 90% of all the really large 1 kilometer near-Earth objects have been found. The challenge now is working down to these smaller sizes that are still quite capable of causing a lot of damage, but they're just harder to spot because they're fainter, they're smaller.
Can you give us a sense of how many are out there in our solar system?
We know that there are a lot of asteroids in our solar system. They number in the billions. Most of them, however, are between Mars and Jupiter in what we call the main asteroid belt. This is a region of space where most of the asteroids in the inner part of our solar system live, and they stay there for many billions of years. There is another population, though, that kind of leaks inward and gets into the region somewhat close to the Earth, and we call these near-Earth objects. We think that there are millions and millions of near-Earth objects that are out there in the total population. As of today, we know of sort of around 20, 25,000, something like that. When we first spot an object, we really know very little about it. We just see something moving across the sky. So all you get is just sort of a handful of snapshots, just enough to be able to tell that this isn't an asteroid that we've already seen before. And then once we can calculate the distance to it, we can now start to make predictions about its true size. Is it large or is it small? So we have a lot of information that we have to get pretty quickly to really understand what's going on.
Finding asteroids is just one piece of the puzzle. Planetary scientists are extremely skilled in determining the orbits and speeds of asteroids based on relatively small amounts of data. NASA runs simulations of the trajectories asteroids could take, which is useful but time-consuming. A team of scientists in the Netherlands have found a way that could buy us more time.
Our method is very quick. So you can very quickly get an assessment of whether or not the object is dangerous or not. If you look at the classical way of determining the danger of an asteroid, it may take days of computing time on very big machines to determine this hazardousness.
The current problem is that there's just too many asteroids out there to spend a huge amount of computational power on all of them. So the neural network allows us to focus on what really could go and pose a hazard to Earth.
A neural network is a computing system that mimics the way the human brain operates to find underlying relationships in a set of data.
By training the network in this way, you train it in recognizing those objects that are most likely to hit the planet. And once it's trained, you can apply this network to all the unknown asteroids. And then you can make a selection and saying, hey, these are the ones which appear to be having orbits similar to the ones which we know are hitting the planet. That doesn't mean that they do, but it only means that they look very similar to the ones we know they do.
What else did you find? Should we be particularly concerned about anything?
One thing that we did find is that our neural network was able to go and identify a handful of asteroids which weren't considered potentially hazardous, that when we went and integrated them forward in time, they came quite close to Earth.
We find a handful which were not detected before or not considered being dangerous before, and we think they are potentially dangerous.
It's very hard to simulate kind of going forward in time an asteroid that's going to hit Earth because, well, the Earth is really small. And space is really big, and then you have to have very exact parameters to shoot an asteroid that goes and hits exactly Earth. And then Simon had the ingenious idea of not even trying to do that and just launching the asteroids from Earth's surface and integrating backwards in time.
It's very hard to make it hit. So you need a lot of calculations which all end up in nothing. And the idea was then like, well, let's not do that. This is basically what NASA is doing. NASA is taking an asteroid, making multiple copies of them, shooting them all forwards in time, calculating their orbits, and then see what fraction sort of gets close to Earth. Not even hitting Earth, but getting close to Earth. And that they call it a potential impactor. So you calculate the solar system forwards in time for, let's say, 1,000 years. And then you launch asteroids from the surface as if they, if you go forwards in time, would fall on the surface. You calculate them backwards to today, and then you get your orbital parameters of today's asteroids, which you know will land on the planet. And those you can use as known impactors and compare with all the other asteroids in the solar system.
Can simulations and AI, can those things fill in the gaps where perhaps telescopes and other imaging tools can't?
Absolutely. Since the observations get more complex, the physics gets more complex. And if the physics get more complex, the mathematics becomes more complex. And at some point, you can't solve your problems analytically anymore. And then this is where the computer comes in. Now we have this trained neural network. We have a way of calculating in a fraction of a second whether or not an asteroid is potentially dangerous or not, and therefore deserves more attention or more time to spend on for really finding out if it is dangerous.
When it comes to hunting asteroids, time is critical.
What we can do about a potentially hazardous object depends a great deal on what we know about it and how much time we have before the encounter. We'd really like to find them when they're decades away, because the more time you have, the more options you have, and the less energy it takes to move an object aside.
It also means we might not have to resort to launching a nuclear warhead at an asteroid. Until recently, pretty much our only choice.
That's an option of last resort, in my opinion, yes. We have lots of options available. You can just simply bump into the object and just nudge it out of the way. That's one possibility, and that's kind of, in a way, sort of the simplest thing to think about, just nudging it off its path a little bit with, a massive object, a spacecraft, let's say. It's just kind of like bowling, if you will. If you have a long time or a long stretch of runway in the lane, just a very small twist on the bowling ball will make a big change in where it ultimately ends up. Another option would be something where you take a very big, massive spacecraft and you park it next to the object and you use the force of gravity as a towing rig. That takes longer, though, and you need to be able to send a pretty massive spacecraft, and it obviously depends a lot on how big the asteroid is. Other options start to get more and more complicated, and they range from painting one side of the object a white color and painting the other side dark, and then letting the pressure of light sort of perturb its orbit.
In a departure from the lab and computer simulations, NASA has real plans to rehearse kinetic impact deflection. In 2021, the agency will launch DART, the Double Asteroid Redirection Test mission, which will intercept a 160-meter asteroid in 2022. Better to practice now before we have to deal with an actual threat. In the meantime, discovering asteroids is our best bet. Thousands of scientists and amateur astronomers around the world make up an informal network that survey the heavens. But that may not be enough. NASA wants more resources to map our solar system and better technology.
We need to ramp up our network of sensors, and also we need to just continue to strengthen our network of international observers so that we can get follow-up, because we find these objects when they're distributed all over the night sky.
Once we get more observations, we get better data, we can make better predictions.
If you look at the big impactors we have had in the last, let's say, 20 years, or maybe 30 years, or 50 years, most of them we haven't seen coming. So the real danger, I think, comes from the objects we don't know about, and not from the objects we do know about.
This particular natural disaster, like a lot of natural disasters and like climate change, is a problem of the global commons. So the thing that we risk collectively is that it sort of then becomes nobody's problem, and nobody takes ownership over it. The asteroids are all over the sky. They just truly cross boundaries and borders with a second's notice.
I kind of imagine in the future, maybe lots of small satellites around the Earth that are always going and looking outward. I mean, I think it's something worth investing in. It's our existence at stake.
right?
The pandemic has affected everyone in different ways. Some pass the time by baking.
Homemade sourdough bread. Do I need to say more?
Some chose to binge watch Netflix.
It's your game.
Or maybe you started a garden oasis in your backyard.
Next, I'm going to put my lettuces in.
But for millions of others,
I'm going to be posting stocks that will boom.
They wanted to uproot the financial industry.
Let's just lock it on up and take $15,000.
Here's a stock that can change your life.
I see a stock going up and I buy it and I just watch it until it stops going up and then I sell it.
I have gained over $3 million.
I want some free money.
I don't think you can overstate the online communities or social media's influence on financial markets.
A large group of inexperienced investors who discuss their plans on social media platform Reddit have shaken up the stock market in a big way.
The stock that everybody's talking about right now is GameStop.
Video game retailer GameStop is set to continue their head-spinning ascent today.
The revolutionaries on Reddit are spanking Wall Street's ass.
The more these stocks go up, the more the big guys are getting creamed and losing billions of dollars.
This isn't a wealthy person's game anymore. Anyone can play it.
I took up a little bit of a new hobby, and I am interested in day trading.
As an investor nowadays, you don't have to look a specific way. You don't have to wear specific clothes. You don't have to be doing it from a trading floor on Wall Street in like a high-rise building in downtown Manhattan.
The narrative of what's driving the markets is no longer being held in secret offices in New York and Boston of privileged people talking to other privileged people. It's right out in the open. It's on Twitter, it's on Reddit.
From brokerage apps to Discord channels and subreddits to TikTok finfluencers, one of the last holdouts in the world of disruption, finance is next in line.
Investing should be as ubiquitous as shopping online.
That's Vlad Tenev, the CEO of Robinhood, the online brokerage app, talking about how he wants his app to disrupt the world of stock trading like Amazon disrupted the world of home shopping.
And I think that speaks to exactly the mission that a platform like Robinhood has, which is to democratize investing.
Robinhood was started in 2013 by Vlad Tenev and Baiju Bhatt in, where else, Silicon Valley, as an alternative to the big brokerages, but with one big difference.
As they were building the social network around finances for people, they realized that there was a gap in the market and that free trading could become something that they could bring to the markets, they could disrupt the industry.
While no-fee trading is industry standard today, it was unheard of when it was first introduced.
The online brokerage industry was really innovative when they came on the scene 10, 15 years ago, but they kind of stopped innovating where you haven't seen those commissions come down beyond $5 or $6 or $7. Robinhood think that by offering zero commission that they're going to push people onto this platform.
And on top of no-fee trading, the customers Robinhood was courting have been long overlooked in the world of finance.
So the typical customer of a Charles Schwab, for example, is putting a lot more money in that brokerage account than the typical customer at Robinhood. Even today, with all of its popularity, the median account size is about $240.
There's Fidelities in the Schwabs and the E-Trades of the world. They look down their nose at those kind of accounts. I don't want a $1,000 account. They're just a headache. I want a $100,000 account.
And this is key here, right? Because the thing about Robinhood that's different than every other single brokerage platform is how easy it is to use.
The design of the Robinhood app really has in mind a user who might be coming at this absolutely cold.
The fonts are very well sized, the shapes, the colors, all of that is something that the founders of Robinhood paid really close attention to.
And by creating an interface that catered to a newer investor, they were able to gather a pretty healthy group of customers. And by 2019, they had about 10 million customers.
Those 10 million customers were a huge success story for Robinhood, but no one could have predicted its explosion after the arrival of COVID-19.
Remain indoors to the greatest extent, and 100% of the non-essential workforce must stay home.
What we saw when the pandemic hit was the growth of Robinhood users absolutely turbocharged. And oddly, you saw this surge in interest in stock trading. Then they saw the absolute surge in 2020 in customer growth. And now, by many accounts, they have more than 20 million customers, which is pretty extraordinary. So the next step for them is to figure out how to monetize those users and how, even with their small account sizes, to get them to grow with the company and, as it releases more products, come along with them.
Robinhood would become one of the COVID economy's breakout successes. Robinhood traders, as they're called, became the shorthand explanation for the frenzy of often speculative retail investing after the pandemic lockdowns.
Kids wake up in the morning, they go on Robinhood. They're, in the shower, they check Robinhood. Kids are learning how the stock market works at 18 while they're at school, checking their phones in between classes because notifications pop up telling them what their stocks are doing that day.
With these new tools, millennials and Gen Z are investing in the market in ways their parents could have never even dreamt of.
That is sort of key when we talk about the divide